Fed has all the evidence they would need to either cut or stay put.
We think the Fed could probably cut rates 4 or 5 times this year.
We are talking about rate cuts. It's a question of when.
As you see from the policy speak, there is no hurry for cuts anytime soon.
People talking about the resiliency of the U.S. economy. We think that will continue and push out when the possible Fed easing cycle starts.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your week started. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowicz together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 totally unchanged on a 4-day winning streak on the S&P 500. 5 weeks of gains. Bramo rising 14 out of the last 15 weeks. The longest streak, I think, going back to 1972.
And crossing that 5,000 mark, that threshold that we were flirting with, this record high, this question of what's behind it, it still is the Magnificent Seven or the Magnificent Five or the Magnificent Four. It still is disproportionately weighted to big tech. We're not seeing the full broadening out yet. So have we gotten conviction yet? Or is this just simply there's nowhere else to go other than up? If
you want more earnings, Nvidia just around the corner, about a week away. CPI, the next stop for this market. So looking ahead to CPI this week, the president had the opportunity to do a pre-Super Bowl interview. He declined. Some people who were attached to the campaign for the president suggested that there weren't enough eyes, potentially, on that particular conversation. So instead, they put out a video, Anne-Marie, on shrinkflation and the nation for President Biden.
President Biden is still trying to win on the economy. In this video, what he's talking about is that companies are putting out less of a good, but for the same price. We've heard the White House complain about this. You know, 2 things that come to mind. Why would you remind viewers on the day of the Super Bowl that potentially there's less Oreos in their packet or less Doritos in their chip bag? And second, we heard from Unilever last week, which is one of these companies that has actually have said we're doing shrinkflation. We don't necessarily think it's a good idea, but the fact of the matter is we have higher costs and we are dealing with competition from local grocery store brands. So it's just reminding the American consumer that there is still an underlying issue of inflation.
And it raises this question, just even more so, why he didn't speak in a more candid, kind of loose, off-the-cuff sort of address other than this. He said he wanted to sort of not destroy the mood. People just want to have fun, et cetera.
Sure.
What do you think shrinkflation is? You know, I mean, does he think that's emboldening the move?
Shrinkflation is a Debbie Downer.
Is this resonating with voters? The answer is no. FT out with a poll together with the University of Michigan Ross School of Business. 42% of Americans said they felt Trump would be a better steward for the economy. Anne-Marie, 31% choosing Biden, 21% saying they trusted neither candidate.
We've seen this in poll after poll, including our own polling. When it comes to the economy, when it comes to handling of inflation, voters still think that they would be in better hands of the former president, though we need to remember the timeline might be on this president's side. What we have seen from the latest Michigan survey, the Conference Board, people are starting to feel better about the economy. I'm not sure if the president should have reminded them that some of their packaging has a little bit less crisps in them.
So that's the economy. Let's talk about foreign policy, shall we? Because that was the big headline over the weekend. Nikki Haley coming up a little bit later in the programme. Get that in the diary. 7:30 Eastern Time, so about 90 minutes away. AMH, the former president, with some controversial remarks on NATO and the former ambassador to the UN's husband.
That's right. So when it comes to NATO, we've heard this from Trump again, talking about, quote, delinquent NATO partners, pointing the finger at Europe. The issue is, Jonathan, for many, it feels like he crossed the line, saying he would tell Russia to go in on some of these partners that are not reaching their defense target. I was really struck by the reaction from the GOP. Some members of the GOP, like H.R. McMaster, who worked for the former president, telling the New York Times this is irresponsible. Lindsey Graham, though, Senator of South Carolina, saying, I don't even know why you're asking me about this. We know how he feels about NATO. Marco Rubio saying he's not a part of the Council on Foreign Relations. This is how he talks as a politician.
More on that coming up a little bit later. Here are the scores this morning, and good morning to you all. Equity futures on the S&P 500 totally unchanged. In the bond market, yields down about a basis point or so, 416.18. Crude negative 0.75%, 76.25. And Lisa, we've all got an eye out this morning for the potential of another deal in the Permian. Another big deal.
And it looks like it has just been announced that Diamondback is planning to merge with Endeavor in a deal that is valued at about $26 billion. This just sort of speaks to the consolidation that we've seen in the Permian Basin. You wonder how much some of the acquisitions by the likes of Exxon and Chevron have kind of accelerated this type of consolidation. We're expecting more of the same. We'll get more details coming up.
It's amazing, isn't it? Go through the names. Exxon acquiring Pioneer, about $60 billion deal. Chevron taking over Hess, $53 billion. Oxy purchasing Crown Rock for close to $11 billion. Have we completed the consolidation in that patch now?
A lot of people are saying no, but the big deals have been done, right? So now you can expect smaller mergers. The idea here is, first, you have an understanding of what it will cost to get it out of the ground, and then efficiencies of scale at a time, where there isn't going to be the same kind of focus on just getting more and more drills into the ground and more kind of production out on the other side.
Diamondback seeing that deal to close in the fourth quarter of this year, fourth quarter of 2024. Javier Blas of Bloomberg Opinion with us in about 25 minutes' time on this deal. Look out for that. Coming up, Max Kettner of HSBC as the S&P 500 pushes past 5K. He'll join us in just a moment. Terry Haynes of Pangea Policy as Donald Trump takes aim at NATO. And Pooja Sriram of Barclays with the latest read on US inflation just around the corner. CPI drops tomorrow morning. Right now, though, we begin with our top story today. After closing above 5K for the first time ever, equity markets are kicking off the week at fresh all-time highs. Max Kettner of HSBC is cautious on the road ahead. We are more concerned about longer-run Fed rate expectations, which have risen over the last month. This has not inflicted any pain on the S&P 500. That could change. Continued rises in rate expectations are more likely to prompt a pullback in risky assets and safe havens too. I'm pleased to say Max Kettner joins us now for more. Max, let's get straight into it. You're calling it the reverse Goldilocks trade. You've started to see rates reprice. Equities, though, haven't budged. Why not?
Yeah, good morning. Look, I guess the rise in rate expectations and the rise in long-end yields hasn't really been enough yet. I think this is quite similar to where we've been in summer last year, right, where equities were rising significantly as well in May, June and July. And at some point, the rise in yields was just too much. And then suddenly, actually, interest rate volatility was picking up. So the reason I think why it's really not hurt multiples yet, and why we've been sort of not really particularly bothered with lower than expected earnings delivery outside of the Magnificent Seven has been number one, of course, because of this tremendous earnings delivery of the Magnificent Seven, but number two in particular from a broader market perspective, because interest rate volatility is still very, very benign. And as long as that continues, that's not going to hurt equities and other risk assets just yet.
So, Max, can you talk about how you're positioning at a time where there does seem to be this momentum? There is an increase in dividends. We saw Goldman Sachs come out this morning and increase their dividend expectation. You're seeing strength underpinning some of the ratcheting back of the rate expectations. So why wouldn't you be slightly bullish, even if you're concerned about go-go or row-row or whatever the new acronym is?
Yeah, look, I guess there can be too much of a good thing. And that's the concern that I have right now. Go back to where we were in the summer last year, right? Go back where consensus actually expected 0% GDP growth, and it ended up being 5%, right? Where earnings expectations were nowhere near what the actual earnings delivery ended up being, right? I think we started Q3 with sort of $54 on the S&P earnings, and it ended up being more than 58. So at the face of it, you should have bought equities. You should have been really, really bullish. But the problem, of course, was that a little bit of an uptick in inflation back then was already enough to inflict a bit more interest rate volatility and to send a bit of pain across the asset classes. Now, look, I'm not advocating for like the next 6 to 12 months things to be absolutely dire. No, but I do think with particularly also systematic investors, the likes of CTAs, risk parity strategies, volatility target strategies, all of those really running quite elevated equity exposure already that were a bit ripe for a pullback, and you want to buy into that pullback then. But for now, right, it's really hiding out in shorter duration stuff, short duration investment grade credit, in things like low beta rates, right? So out of the higher beta stuff like gilts, like BTPs. Within equities, it's the short duration, the cyclical markets, actually, things like Japan, things like Latin America. And we do still, given that positioning is very, very low contrary to equities, we do still like really commodities and in particular energy here.
Yeah, that's where I wanted to go. This idea that the only diversifiers can be found, you wrote this, in oil, energy, and some commodity markets. Why do you say that at a time where that trade seems to have failed and a lot of people talk about an oversupply from the U.S. relative to demand?
Yeah, look, when we look, for example, at the performance picture between, let's say, the September and the November FOMC meetings, what happened was that virtually all the asset classes went down, whether that was in rates, whether that was investment grade or high yield credit, whether that was in equities. So really, almost everything went down with this little bit of tiny whiff of hawkishness from the Fed back then. Whereas what that happened between the November and the December meeting, that was the exact mirror image that everything was swept higher. And commodities were sort of doing its own thing, particularly oil, right? You mentioned the supply picture, but I do think when we look at, for example, US supply, that's very much baked into the cake now. Whereas when we look at it from an investment perspective, yes, the front end of the curve has gone more into backwardation, so long positions are much more attractive now. The demand picture actually is kind of fine, and now we're starting to see signs of inventory restocking again, manufacturing globally starting to pick up, and that generally really argues for commodity exposure, cyclical commodity exposure anyway. And then when we look at broader commodity positioning, it's close to all-time lows. Energy positioning, net longs of managed money, non-commercials is close to 10-year lows, right? So it is, like you said, a very, very unloved trade that we would be very happy to jump on rather than now chasing the Magnificent Seven higher.
Max, just to wrap it up, going into CPI tomorrow, I think a lot of people are still comfortable being long risk, even as data surprises to the upside, because as far as they're concerned, there is little evidence that stronger data is derailing the disinflationary trends of the last 6 months. Do you anticipate they're going to be wrong in the next several months?
Yes, I do think so. Not because I think the data necessarily will show a massive, massive second inflation wave, right? I don't think it will show, that we're suddenly going to see core inflation going from 3 to 6% again. No, but because the starting point in inflation expectations, in short-term inflation expectations, is so much more dovish now, right? That means we only need a little bit of what we had last summer. Remember last summer, headline inflation just went from 3 to 3.4%. And even that, which at the end of the day was just base effects falling out of the 12-month window, but even that was not only enough to freak out the market, but even the freak out was enough to freak out the Fed, right? Even the Fed was adding one additional hike in December. So all we need is a tiny whiff of less dovish data. And it, I think, would already be enough to send a bit of pain across all the asset classes.
Inflation data tomorrow morning, 8:30 Eastern Time. Max, it's good to see you, sir, as always. Max Kettner there of HSBC, looking for reverse Goldilocks, Bramo, to hit this equity market.
You know, one of the key questions, and actually Savita Subramanian wrote about this late last week from Bank of America, if the Fed doesn't cut rates, or if inflation is just a touch higher than people expected, does that kill the equity rally? Max says yes. Savita Subramanian says no. And ultimately, that's one of the key questions underpinning this market right now.
Right now, that's what makes a market. Equity futures totally unchanged on the S&P 500. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Diamondback Energy and Endeavor Energy Resources are set to merge in a deal that's valued at about $26 billion. The new U.S. oil and gas production giant would be valued at over $50 billion. It is just the latest in a wave of consolidation in the energy sector. Exxon and Chevron both made major acquisitions over the last 12 months. President Biden's re-election campaign has launched a TikTok account. It's the first time Biden has joined TikTok in an official capacity. The Chinese-owned app has been embroiled in controversy in Washington, where government employees are banned from having TikTok on their agency-issued devices. The move is part of a broader strategy by the campaign to reach younger voters on social media. And the Kansas City Chiefs have been crowned the first back-to-back Super Bowl champions in 19 years. The Chiefs defeated the San Francisco 49ers by 25-22 in overtime. Quarterback Patrick Mahomes was named MVP. Taylor Swift, of course, did make her much-anticipated appearance. She cheered on boyfriend and tight end Travis Kelce. That's your Bloomberg Brief. John.
Hey, Danny. Thank you. Honestly, I understand the entertainment value of it, but what was that fuss about, her making it in time? She had hours and hours to spare. I think she had a night to go to sleep at home before even making it to Vegas.
People just wanted some drama. They want to understand this is a movie.
And that's how they manufactured it.
They manufactured it in every level.
I think people saw the dates and then didn't put into account the time difference between Japan and the United States. But yeah, this felt like pure entertainment. But this morning, USA Today says for all those people saying there's too much Swift, she was on all of 55 seconds during how long is this? 4.5 hour Super Bowl?
It feels that way.
No, that
4
is.
hours.
4 hours.
Honestly, it was commercial.
Every
Commercial.
That's why people watch.
I know, for the commercials. We can talk about the commercials a little bit later. I know you've got views. I know you've got views. Up next on this programme, Trump taking game at NATO.
One of the presidents of a big country stood up and said, well, sir, if we don't pay and we're attacked by Russia, will you protect us? No, I would not protect you. In fact, I would encourage them to do whatever the hell they want.
Reaction to those comments up next, live from New York City this morning. Good morning. Equities on the S&P 500 totally unchanged this Monday morning after closing above 5K for the first time ever on Friday going into the weekend. Yields are a little bit lower this Monday. We're down a basis point or two, 415.99. Under surveillance this morning, Trump taking game at NATO.
And I said, you got to pay up. They asked me that question. One of the presidents of a big country stood up and said, well, sir, if we don't pay and we're attacked by Russia, will you protect us? I said, you didn't pay? You're delinquent? He said, yes, let's say that happened. No, I would not protect you. In fact, I would encourage them to do whatever the hell they want.
Here's the latest this morning. Donald Trump's comments over the weekend stirring up backlash from world leaders. Terry Haynes of Pangaea writing this. A world in which the declining influence of US foreign policy is not only happening, but is on active public display, is a world in which geopolitical risk rises for markets. Terry, I'm pleased to say, joins us now for more. Terry, let's go straight to those comments from the former president over the weekend. I won't get into the motivations. That would require you to get into the head of the former president. Let's talk about the consequences. What do you think the consequences are?
Well, I think the consequences are that it makes people very nervous. And I think, frankly, and I'm not meaning to dispel the nervousness, but I think it makes people more nervous than they should be. If you want an indication of the true intent of the United States establishment, you have no further to look than the National Defense Authorization Bill that was signed into law a couple of months ago that requires congressional approval before you leave NATO. So what you've got here is essentially Trump red meat that's designed to amplify an isolationist message. That's all well and good, but it doesn't match up with either the intent of Congress. It doesn't match up with the intent of the broad intent of the American people either, frankly. You have not only pretty much united support for Israel, but you've got 3/4 of the House and almost all of the Senate supporting Ukraine as well. So there's a real disconnect between what Trump is saying and what the United States government thinks and feels and acts on.
But Terry, we've seen at times Republicans get in line behind the former president, most notably with the border deal. Is it concerning to you that Republicans will line up and become softer when it comes to NATO?
I think it's a risk. Right now, I don't think it's more than a trailing risk, frankly. As I say, I think the vast majority of Congress is in favor of supporting Ukraine, supporting Israel, supporting what I think of as the global leadership obligations of the United States. I don't think that's going to change markedly. I think we're at a moment now where a lot of individual members and senators are looking at their own bases. I mean, they're not thinking about Trump. They're not thinking about national. They're looking at their own bases and saying, okay, kind of how do I navigate through this particular shoal? And what you're going to see is things that look like more support for the Trump position than they actually are. And, I think that's a mirage largely.
Terry, you mentioned the foreign policy aid bill that cleared a critical hurdle in the Senate over the weekend. What's its chance for survival in the House?
Oh, I think it happens in a couple of weeks. I think the House ends up having to bumble through this. If you proceed from the assumption, as I do, because this has been demonstrated in votes, that about 3/4 of the House supports Ukraine and I think therefore supports Ukraine aid. I think the House Republican leadership, which controls the ability to put things on the floor, is going to come under an awful lot of pressure. There's a couple of and it's going to have to spring this bill loose. A couple of ways to do that. One of them is to use a special suspension calendar that requires 2/3 of the overall House. You saw that used just a couple of weeks ago in the tax bill. The other way to do this is to employ what's known as a discharge petition, a simple majority of members of the House requiring that a bill be brought to the floor. I think generally speaking, I think the House Republican leadership would prefer not to be embarrassed further after the many embarrassments that they've brought upon themselves just in the last week or so. That's not foolproof, of course. They might prefer to be embarrassed more, but I think in the end, this gets done.
There's a question about the potential volatility also because neither of the candidates for president are well liked. Over the weekend, the White House really tried to push back against the special counsel report, calling it a cheap shot, saying that the special counsel was trying to score political points. What do you make of the rebuttal from the White House?
I think it's... you're all familiar, I'm sure, with what's known as the Streisand effect, where Streisand complained to Google Earth that her house was in view, and of course everybody started to look, even further at the Streisand house to make sure that they could see it. I think you've got Streisand effect going on here. The White House continuing to protest. Goodness, they even sent out a fundraising letter over Jill Biden's signature, Mrs. Biden's signature, over the weekend a couple of times, protesting all of this. Look, this was a disaster for the White House, and it's an ongoing disaster for the White House, and they're going to have to deal with it. They can't deal with it by denying it. Secondly, you've got a situation where, the good news is they've got 9 months to deal with it. Thirdly, I do think, for what it's worth, that the special counsel piled on. Special counsel could have said what he thought about the reasons not to prosecute without going into what amounts to opinion. But it's out there and it's done. They're going to have to deal with it, but they can't deal with it by denying it, or as one pundit put it over the weekend, hey, the good news is Biden's been making gaffes for 40 or 50 years, so nothing new about this. Happy talk.
But Terry, do you get the sense that there is a greater chance of another Democrat coming in to take his place in the election?
No, it is not. The Democratic primaries are not set up for that. What it's going to take is, so Biden rolls on. There's no serious Democratic opposition. What it's going to take is, by the time you get to the convention in the summer, you're going to have to end up with rogue delegates. You're going to have to get some further change in Biden's condition, or a bunch of rogue delegates saying, you know what, we're not doing this. I don't care what the rules say.
Hey, Terry, great to hear from you. Terry Haynes of Pangea Policy, just perfectly framed about the situation in Washington, D.C. and for the nation. The president rolls on, seems to be the takeaway from Terry.
Which is sort of the reason why a lot of people are wondering what's actually going to happen in November at a time where it's, I don't know how you can explain what's going on right now. They're basically, he said, the Streisand effect. I mean, it was sort of this over the weekend talking about this, denial that just put more focus on concerns that a lot of Americans have right now.
So the questions are now going to become, which is potentially why you have to think the White House thought we are not doing a Super Bowl interview if they potentially thought this was going to be one of the top questions, because it continues to be on top of voter minds, is that you're going to look now for those gaffes. Yes, he's been making gaffes for 20, 40 years, but now they're going to become more apparent because the special counsel said they think he's a well-meaning but elderly man who has issues with memory.
It's hardly a great message to send to the electorate, isn't it? We've been doing these gaffes for the last 20 to 40 years. They shouldn't matter now. It's not a great message.
Again, it's sort of, why isn't he addressing the real issue, right? Why isn't he coming out? There was speculation about why he didn't go to the Super Bowl and give that interview. Releasing a video doesn't put those concerns
on shrinkflation.
Yes, exactly.
Yeah, I'm not sure how powerful that is either. Here's the situation. You've got potentially a former president undermining the collective defense clause of NATO. One, you've got the focus on President Biden on his mental acuity. Two, and you wonder how this shows up in the polls. I'm not sure the comments on NATO make a difference to the polls whatsoever.
No, and this is the issue. Does you get people just staying home? Do you get people more emboldened, or do you just have a resignation to a reality that a lot of people don't want?
The conversation continues. Equity futures unchanged on the S&P 500. Live from New York, this is Bloomberg. Four-day winning streak on the S&P 500 through Friday, coming into Monday. Equity futures right now look like this. Good morning to you. Unchanged on the S&P. Unchanged on the S&P. On the Nasdaq, slightly firmer, positive by almost 0.1%. Closing above 5K for the first time ever on the S&P 500 just last Friday, stringing together a fifth week of gains. The team here at Bloomberg doing the counting, so I don't have to. It took 719 sessions, Lisa, for the index to set its latest 1,000-point milestone, a gain of 25%.
Basically, what we're talking about is the unloved rally that was driven by a small select group of stocks. And so here's the question. Is this something that's momentum that you cannot fight against, or is it something that is looking a little frothy and set for a pullback if people look at inflation and see maybe the rate cutting expectations are a little too far advanced?
You know what was impressive, though, is that we've pushed back against those rate cut expectations, and still this equity market is looking all right. Go to the bond market, take a look at the 2-year. Down about a basis point today. Your yield on a 2-year at the moment, 446.75. But the 2-year had another soft week last week. The yield climbed by more than 11 basis points. The data was pretty strong, Lisa. ISM services, jobless claims a little bit lower. The pushback continued by Fed officials. It was reinforced by the information we had looking at economic data in America.
That's why I really related to this question that Savita Subramanian asked. With a rate cut in March likely off the table, some are asking, what if the Fed doesn't cut this year? And she says stocks can still gain. I wonder how much this has to do with dividends, how much this has to do with buybacks. Goldman Sachs talking about how everyone was increasing their dividends and buybacks. We saw this with the latest energy deal as well. Here is the question. Are stocks the new income play at a time where bonds are subject to potentially, price risk and inflation risk?
In a word, earnings. Bloomberg Intelligence. This number's incredible. The Magnificent Seven are projected to post combined profit growth of about 55% in the fourth quarter.
I mean, that's the thing. They're real. So when people say this is another 1999, other people say, really? It's not just, a sort of a placard with nothing behind it and 15 employees who are hoping to pay themselves with debt.
Who are you suggesting that was? 99?
Yes. I'm just saying that there's not this feeling of like a shell company that's going to go bust.
Yes, it's real.
It's real.
It's real. NVIDIA earnings, by the way, next Wednesday, I believe, 2 Wednesdays away. Let's turn to foreign exchange off the back of that bond market move. I was just trying to work out who that was a rant about specifically. The euro, 107.70. That currency pair negative here by 0.1%. Under surveillance this morning, here are your top stories. 2 hostages are free after an operation by Israeli forces in Gaza. Israel is ramping up strikes in Rafah near the border with Egypt as Prime Minister Benjamin Netanyahu vows to continue the military campaign. According to the White House, President Biden spoke directly with the Israeli leader yesterday. Biden telling Israel not to proceed without, quote, a credible and executable plan for the safety and support of civilians. Annmarie, it's worth talking about Rafah. In the southern part of Gaza, this is where many civilians had fled to after this conflict started.
This is where more than 1 million Palestinians have taken refuge. They moved south. The Israelis told them to move south. And that is why this has become an issue that not just from the White House, but capitals around Europe are saying they are incredibly concerned about the safety of these people. What struck me this weekend in my readings, what the Wall Street Journal reported, Egypt, which is a mediator in these talks, has warned Hamas that it needs to reach this accord about the hostages about 2 weeks, or Israel will proceed with the Rafah invasion, which I believe we already saw the start of that overnight.
Much harder stance coming from the President of the United States. And Lisa, given where the polls are right now for President Joe Biden, you'd imagine an even harder stance is going to come in the weeks and months ahead.
Especially because privately he's been telling a lot of his aides that he really disagrees with Netanyahu, the Prime Minister of Israel, and that he actually thinks that he's not necessarily being as reasonable as he would like, and he doesn't really have as much influence. Question is why he hasn't gone public with that. Especially because Netanyahu is not popular in Israel. And a lot of people think that he's more extreme and not protecting the nation.
We did see some of that, though, creep out from Biden last week when he said he did think of what Netanyahu was doing was, quote, over the top. So a little bit of that frustration is starting to come out. But I agree with you, Lisa. The frustration is palpable behind the scenes.
The focus is back on the Pentagon. Defense Secretary Lloyd Austin is back in the hospital. He was admitted to Walter Reed National Military Medical Center last night for symptoms suggesting an emergent bladder issue. His doctor's saying, quote, at this time, it's not clear how long Secretary Austin will remain hospitalized. Austin's duties have been transferred to Deputy Defense Secretary Kathleen Hicks. Some real concerns about his health at the moment.
Absolutely. So two things notable about this. One, the DOD came out immediately to say that he was being transferred to the hospital. So they clearly learned their lesson of what happened prior when they were less transparent, and even the White House was confused. Second, they also came out after he was transferred to the hospital about 2 hours later saying that he's not in enough of a stable condition where he can continue his duties, so they were able to transfer them. But a lot of concerns. This week alone, he's supposed to have 2 meetings in Europe, one regarding Ukraine and the other regarding NATO defense.
There is far more transparency this time around, that's for sure. Let's finish on a lighter note. The Kansas City Chiefs are repeat Super Bowl champions after an overtime victory over the San Francisco 49ers. A late field goal by the Chiefs tied the game at 19-19. Then quarterback Patrick Mahomes led the Chiefs down the field, throwing a touchdown pass to clinch the team's 3rd title in 5 years. And yes, Taylor Swift was in attendance to support boyfriend and Chiefs tight end Travis Kelce after making the trip from a tour stop in Japan on Saturday with hours to spare, literally hours, overnight a day. AMH, never mind Taylor Swift and Travis Kelce. We want the Bramo review on the commercials at halftime.
Well, really, I found it notable that there were so many movies that were coming out and that they all just said, go to the trailers. I thought that was compelling. I also really liked the Dunkin' Donuts one. That was my favorite.
I did too. That was my favorite, yes.
Absolutely.
You stayed up for it? I was going to say, I find it notable that Lisa knows
before
all about the commercials.
I just watched till halftime.
The headline was Beyonce announces a new country album during the commercials. That was the standout.
You think that was the big takeaway?
That was the takeaway of the Super Bowl, 100%.
I'm not sure a lot of our audience would agree with that. Let's turn to this story. It's M&A Monday. Diamondback and Endeavour announcing they're merging in a deal about $26 billion. The combination will create another oil and gas giant in the Permian. Javier Blas of Bloomberg Opinion joins us now for more. Javier, let's talk about this deal off the back of several other big deals, including Chevron, Exxon and others. Javier, how big is this one? How important is it?
Well, it's a big deal for the Permian. It creates, on my numbers, the 3rd largest operator of oil and gas assets in the Permian region. Very skewed towards the Midland side of the Permian. If you think about the Permian, it is really like 2 areas: the Delaware, which goes into Texas and then into southeast New Mexico, and the Midland area that is more into West Texas. Creates a big company and an amazing growth from Diamondback. It's worth to remember that this company was created only in 2007 with 800 barrels a day of oil production. After the merger, it's going to be producing 800,000 barrels a day.
Javier, I was going through the numbers. Exxon acquiring Pioneer, $60 billion deal. Chevron, Hess, $53 billion. Oxy, Crown Rock, close to $11 billion. What's left? What's left to consolidate?
I think that we can still see more consolidation in the Permian. We have seen the biggest deals, the most obvious ones, some of them family-owned companies that they wanted to cash out, or they have a transition at the head of the families. But I think that there are still too many Permian companies in the kind of range of 250,000 barrels a day that they need to combine among themselves. So I don't think that we are done. I think that we are going to still see big numbers of consolidation, but perhaps the biggest tickets, we have already seen them.
What's the goal behind some of these mergers? It is just simply economies of scale? Is it that you can get more production if you have some sort of strategic method that goes across a bigger swath of land?
I think that synergies, economy of scale is very important. The Permian has really moved into the phase of mass production of barrels of oil, and there reducing your cost per barrel is very important. And I think it's also creating companies large enough to tick the box of investors that they require companies in the range of $30, $40, $50 billion to invest. And that's what I think, that those companies that they are still sub $25 billion of market capitalization, probably they are going to have to look for merger options to create larger vehicles that can attract the attention of investors.
Javier, when you wake up and you see a deal like this on top of the others John noted, do you think these energy executives considered what they're doing to be, quote, stranded assets, as the Biden administration has called them?
No, I don't think that they see them as stranded assets. I mean, obviously, the sellers think that the buyer is paying a good price, a good return, but I still see demand for oil. We see global oil demand growing. It's going to reach an all-time high in 2024. We are going to hit peak oil demand perhaps in the 2030s. But what we are seeing is so far very, very healthy demand. I mean, we are talking this year in 2024 about 1.2, 1.3 million barrels a day of oil demand. That is exactly on trend. For the last 20 years, oil demand has been growing every year about that number. So we have yet to see the big deceleration of oil demand, let alone a peak in overall oil consumption.
Shale roaring back from when prices hit negative, Javier. What does this message send to the likes of OPEC, like Riyadh and Moscow and Abu Dhabi?
Well, I think that there is a big problem for OPEC because last year, this year, most likely next year, we're going to see a lot of oil production in the Americas. It's not just the Permian or the United States. It's also Canada, it's Guyana, it's Brazil. If you put that all of them together, even if the U.S. slows down a bit, all of those countries are going to be able to add probably around 1 million barrels a day combined, which is more than enough to offset all the oil demand that is growing around the world. So the main problem for OPEC is that the world is not transitioning away from oil. It is transitioning away from OPEC oil into American oil. And that's what is constraining OPEC producers like Saudi Arabia.
Javier, that's such a fantastic point. Does that explain how comfortable we are with the situation in the Middle East, specifically in crude markets at the moment, with prices still pretty low relative to the tension we're seeing play out?
You have told me 20 years ago that we were going to have a big military campaign in the Gaza Strip again, significant attacks by the Houthis into commercial shipping into the Red Sea, resurgent Iran, and oil prices were going to be under $100. I will have not believed it. And here we are. And that goes into how much oil production has grown in America. Let me just finish with a piece of data that was on my column this morning. If you add the United States total petroleum production and Canadian total petroleum production, that's 25% of the world's oil production right now. 1 in 4 barrels of oil today are produced in the United States or Canada. And that really is why the tension in the Middle East is having limited impact in the oil market.
The North American cartel. Javier, thank you, sir. Javier Blas of Bloomberg Opinion. I remember TK years and years ago, more than 10 years ago, called it Saudi America. That's what it feels like, 13 million barrels a day plus.
Yeah, and coming at a time where there is this goal to try to bring down prices ahead of the election and in response to a lot of the demand. Here's a question. Is there any sort of coordinated effort to get those barrels out the way that there is in OPEC? Or is it basically a free-for-all? And I think that's really a question. Is it a free-for-all that creates sort of a cap to how high prices could go because they can keep ramping up production, especially with their new corporate structures?
In fact, those numbers are despite the best efforts of the governments in Canada and the United States.
Exactly. That's my point. It's sort of the opposite of OPEC, although, maybe that's, what OPEC is doing.
Well, this is why when you talk to Middle Easterners, they scratch their head feeling like the United States has come from capital to capital in the Gulf, most notably John Kerry, telling them that they need to do more on climate. And they turn around and say, well, look at your numbers compared to our numbers when it comes to crude production.
Crude is lower this morning by about 1%. WTI 75.99, Brent crude 81.24. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Israel launched a series of strikes on the city of Rafah in the southern Gaza Strip early Monday. The Israeli military says the overnight operation freed 2 hostages. The strikes came after President Biden urged Israeli Prime Minister Benjamin Netanyahu to do more to protect civilians. Over 1 million Palestinians have fled to Rafah. That's around half of Gaza's total population. U.S. Defense Secretary Lloyd Austin has been hospitalized for the second time in a month. The Pentagon chief was admitted into care late Sunday with an apparent bladder issue. Deputy Defense Secretary Kathleen Hicks has taken over the secretary's functions and duties. Austin has been criticized for failing to disclose he'd been hospitalized on New Year's Day for complications from prostate cancer surgery. President Biden has called out major snack brands over shrinkflation ahead of the Super Bowl. He didn't name specific companies, nor did he offer a solution on how to hold them accountable for selling less product at a higher price.
Some companies are trying to pull a fast one by shrinking the products little by little and hoping you won't notice. Give me a break. The American public is tired of being played for suckers. I'm calling on companies to put a stop to this.
Even as inflation appears to be slowing, the economy remains a top issue for many Americans heading into the election. That's your Bloomberg Brief. John.
Danny, thank you. Didn't you complain about the size of a Snickers in the last couple of weeks?
Recently, he was in Vegas and complained that Snickers prices stayed the same while the size of the bar actually shrunk. But Bloomberg went out and did a test on this, and actually in America, the Snickers bar stayed the same. It was in Australia where it shrunk.
He's complained about the Aussies.
Honestly, he's like the uncle that shows up who's like, oh my goodness, there's only 5 chips in here versus 8 chips last year. And then everyone's like,
Yeah, this has been going on for like a decade.
And then everyone's
Welcome.
like, all right, let's watch the game. You know, that's sort of what it felt like.
Up next on the program, US CPI, just around the corner.
Certainly a model that you take rates down quickly. That's not a model that's good for the economy. If I could get these kind of numbers sustained and even better broadened, that's what I'm looking for, sustained and broadening.
That conversation is coming up next. US CPI tomorrow morning. The look ahead on Bloomberg Surveillance, just around the corner. "43 minutes away, 7:30 Eastern Time, presidential hopeful Nikki Haley on Bloomberg TV. That conversation just around the corner. Equity futures this morning, and good morning to you on the S&P 500, totally unchanged. Under surveillance this morning, US CPI coming up next.
It's a very strong labor market still. And so gratified to see inflation coming down, hoping it continues to come down. I think we've got some time to be patient. To me, there is certainly a model that you take rates down quickly. That's not a model that's good for the economy. If I could get these kind of numbers sustained and even better broadened, that's what I'm looking for, sustained and broadening.
So here's the latest. US January CPI due out tomorrow, followed by PPI on Friday. Investors looking for inflation to continue heading towards the Fed's 2% goal. Pooja Sriram, US economist at Barclays, writing this. We expect headline CPI to have risen 0.19% month over month in January, taking the annual rate to 3%. Our baseline call is that the Fed will cut in the May meeting, followed by 3 more cuts in June, September and December. Risks remain the first rate cut is pushed out to later in the year, maybe even in June. Pooja Sriram, I'm pleased to say, joins us now. Pooja, let's get into those calls, and I'll ask you this question. Are there any signs at all that are of concern to you that perhaps the disinflationary trends of the last 6 months might be derailed by this stronger than anticipated data to kick off 2024?
Hi, thanks. Thanks for having me this morning. So let me start by saying this, that yes, I do see risks building that could perhaps jeopardize this smooth disinflation that we've seen over the last couple of months. First, of course, is the strong activity data. Activity in the U.S. economy has consistently surprised on the upside, be that growth, consumer spending, labor markets, etc. But outside of that, there are also some near-term risks that could be building. For example, we have the shipping disruptions in the Red Sea. Not very good news as far as core goods deflation is concerned. So I think on balance, we, like the Fed, want to see more data to become confident that this disinflation that we've seen over the last couple of months continues.
Does the recent data that we've seen and the likelihood that CPI is coming down, but that the number that we get tomorrow might be a little hotter than people expect, does that make it more likely that the Fed won't cut this year or only will cut once?
So I think I wouldn't go far as say that they won't cut, but from what we've heard from them, they basically want to build confidence that inflation continues to progress towards the 2% target. And let me explain that. Chair Powell, as well as the recent communication from Fed FOMC members, they were very clear that they don't want to see better data. They just want to see more of the good data. So I think as long as we see this gradual progress down, they should be in a position where they feel confident of wanting to cut. Of course, if the opposite happens and we see risks, inflation accelerating, that's perhaps when they would want to hold off and sort of wait and watch.
What I find fascinating is just this dissonance between consumers who maybe, according to President Biden, are worried about shrinkflation, and economists who think that right now policy is too restrictive. There was a National Association for Business Economics poll published today. More than a fifth of respondents said that the Fed's current monetary policy stance was too restrictive. That is the most going back to 2011. Do you agree with that?
I think there is some truth to that. Look, policy is restrictive. We've raised interest rates more than 500 basis points, and that's a lot. And of course, as you know, we don't have a very clear estimate of where the neutral rate is. But by different estimates, it still looks like we are perhaps at a phase where interest rates are elevated. They could bite into the economy. And maybe there is scope for us to, start to pare those down, especially if the inflation side of the FOMC's mandate looks like it's going to be met. There's really no reason to keep rates at these levels for very long unless there's a real risk on the inflation side.
Let's just pick up on what Lisa showed on the screen. 21% say too restrictive. But you're looking at the labour market alone. We've been at this rate since last summer. How much evidence is there in the labour market that we are too restrictive?
Agreed, John. This is a very, very interesting puzzle that despite these strong labor markets, we've got high interest rates, but we also had a labor market that was just running so hot. But I think a lot of that can be explained by the growth in labor force that we saw in 2023. There was a lot of incoming labor supply via immigration that picked up post-COVID. A lot of increase in prime age labor force participation. So I think there was a lot of rebalancing post the COVID disruption that helped the labor market hold on to its steam despite the high interest rate environment. And I think that really what explains why we could see this hot labor market despite the kind of interest rates that we had.
Pooja, there's an additional way to look at that. The supply response in the economy has arguably kept a lid on price pressure in the labour market. That could be a one-off factor of the last 6 months that's contributed to, or at least helped, the disinflationary trends. Is there reason to believe that continues in the year ahead?
So let me say, share Barclays' view. I think we're becoming a little skeptical that the supply side story could continue for longer. And this is, we've seen data. The last two, employment situation reports really showed, very limited evidence of any improvement in the labor supply. If anything, we've, even after adjusting for population estimates, the labor supply was reported to have declined in the last 2 months. So, going by that, it does appear that the supply side push that we were getting that was helping disinflation is perhaps starting to fade out. That said, the CBO last week put out its estimates of potential GDP growth, and underlying that, a key assumption was that this, favorable supply side effect in the labor market continues. So they're very optimistic that what we've seen in 2023 in terms of, incoming labor supply and growth in labor force continues. So if that pans out, then perhaps yes, we could still get this disinflation story. But we are starting to get a little skeptical that continues.
If that's the case, and we still do get Fed rate cuts, are we talking about the potential for the Fed sort of implicitly accepting a 2-point-something% inflation rate?
No, not necessarily. I think what that implies is we might just get a shallower cycle, which is why, as we wrote in the report, there are risks that this rate cut gets pushed out to, later in the year. We may get fewer rate cuts, in this cycle, at least till such time we get a fair idea of where the demand and supply forces are balancing in the economy.
Pooja, appreciate your take this morning. Thank you. Pooja Shriman there of Barclays, looking for that first cut to come in May. Previously, they were looking for something like March. They've had to push that out, like Bank of America and Goldman over the last few months, off the back of that better than expected data. Tomorrow morning, 8:30 Eastern Time, these are the estimates. Year-over-year headline CPI, we're looking for a two-handle, Lisa, 2.9%. Previous number, 3.4. Core, stripping out food, back out energy. For what reason? We'll talk about that another time. 3.7% the estimate, the previous read, 3.9.
And that would be the smallest year-over-year advance going back to April 2021. So progress, maybe not back to levels that people want. It's just a real question what the trajectory is if some of these year-over-year comps that you were talking about start to fade, right? That really is one of the key questions. And then the other key question is it shrinkflation?
It could be, and we can talk to economists about that later. I'm sure they'll dodge that question because they won't want to get involved in the political connotations around that story. Ultimately, the Fed's not comfortable to start cutting just yet because they're worried about exactly what you've just said. Not shrinkflation. They're worried about inflation stabilising above target, and once they start cutting, they don't want to have to start hiking just a few months later.
And it raises this question, if they cut once by 25 basis points, maybe they don't cut again for months and months. It's not going to be a process. Honestly, at this point, so many people are saying we don't really care anymore. It's just a matter of them having made this pivot and let's move on. And you can hear it in people's voices.
You can see it in the market. That started at the end of October. I mean, like, big time. That's all to see. Next hour, the second hour of Bloomberg Surveillance. Stuart Kaiser of Citi, Gennady Goldberg of TD Securities, Aaron David Miller of the Carnegie Endowment for International Peace, and Republican presidential candidate Nikki Haley at 7:30 Eastern Time. Live from New York, this is Bloomberg.
We have seen inflation coming down, and that's what investors are looking at.
We're constructive on low inflation.
Our base case is still that we're going to see inflation get back to 2% and remain there.
Real wages are inflecting higher. That creates room for job growth, but not resurgence in inflation.
The second half of the year is a story of inflation re-emerging.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance begins right now. Alongside Lisa Abramowicz, together with Annmarie Hordern, I'm Jonathan Ferro. Your equity market on a 4-day winning streak, a 5-week winning streak on the S&P 500, closing above 5K on Friday. Equity futures just about unchanged. Lots to talk about. Another big energy deal. CPI tomorrow morning. Bottom of the hour, about 7:30 Eastern Time. We need to talk about an interview with Nikki Haley, foreign policy, front and centre over the weekend.
Especially given the fact that we do seem to be creating toward an election and people don't want to pay attention to it, and yet it takes all the headlines, and people are wondering what is the policy stance that we're heading into that's going to frame some of the enthusiasm that we're seeing right now from markets.
The former president throwing cold water on NATO over the weekend. Annmarie, I think at best, this temporarily undermines the collective defence clause of NATO. Just temporary. At worst, the situation is this actively encourages the Russian president to carry on pushing forward. And they're the two issues at the moment.
Absolutely. And that is why you have a number of foreign policy hawks very concerned, given the fact that Russia is waging a war in Ukraine on NATO's doorstep. This is what Trump said. He said that when he was in this meeting, which has been reporting about, but he was more emphatic about it over the weekend. He said that if Russia were to do that, if you were delinquent on your spending and to go into a NATO country, quote, he would tell Russia to do, quote, whatever the hell they want to those that were not meeting those obligations. Also, with Nikki Haley, the Ambassador Haley, Donald Trump, Jonathan, over the weekend was very rude about her husband, saying, where is he? Well, Biden tweeted, Major Haley is serving his country. So a lot of foreign policy issues at play right now.
Republican senators asked about this over the weekend. Lisa, Rubio, zero concern. He doesn't talk like a normal politician, like kind of the same thing you've heard a million times.
This is the issue. Can you dismiss this as just simply rhetoric that's trying to be fiery ahead of the election? And this really speaks to this question that we see in Congress currently. Forget what's happening in November, what's going to get passed currently, given the fact that Trump kind of is pulling the strings a little bit behind some of the push-pull in the Republican Party.
That's the politics and the foreign policy. We'll deal with that. I did mention that deal in the energy patch. So over the last few months, we've had a $60 billion deal between Exxon and Pioneer, a $53 billion deal between Chevron and Hess, Oxy purchasing Crown Rock for close to $11 billion. And then this morning, Lisa, Diamondback Energy and Endeavor Energy getting together.
With a $26 billion deal, and it's the largest pure play operator that they're creating in the Permian Basin. Here's my question. Number one, efficiencies of scale, read layoffs. What's that going to look like? My second question with this is just how much is this going to really take out some of the debt in all of the different energy companies as you see all these tie-ups? This is something a lot of people are looking at. And the third question is, what's next? Right? You raised a really good question. Have all the big deals been done? Is that really the case? Or do we see more down the pike?
Javier Blas said the headquarters of both companies are literally a block apart in Midland, Texas. You want to talk about commercial real estate or let that go this time?
I think I'll let that go. I'll let somebody else. I'll let a Midland specialist in commercial real estate come on.
Not the time to get fired up about another CRE crisis in Midland.
Is that real? Is that what you're going with this?
Not at all.
The CRE crisis.
Going to turn
Midland,
to the price action.
we're feeling with you.
Equities on the S&P 500 totally unchanged to kick off a trading week. That's the stock market story. In the bond market, yields a little bit lower. We're down 2 basis points, 4.1521 on a 10-year. Coming up this hour, Stuart Kaiser of Citi and what the CPI report could mean for equities. Gennady Goldberg of TD Securities with yields touching year-to-date highs, and Republican presidential candidate and hopeful Nikki Haley on her path forward from here. We begin this hour with our top story. Stocks started a week at all-time highs ahead of US CPI data tomorrow. Stuart Kaiser of Citi remaining bullish, but warning, quote, with very strong growth data as a backdrop, CPI could lead investors into either Goldilocks or overheating camps. Stuart Kaiser, I'm pleased to say, joins us now for more. Stuart, let's go straight to it. You've got a clear line of sight, I think, on this equity market now. You've been telling us how good data is good news for stocks. Do you think it's going to continue to be that way?
That's our view. We think the strong underlying data, is a good environment for owning equities from a macro perspective. What's different now is that for a period of time, you had like the quote unquote hard economic data that goes into GDP was really strong, but more of the survey forward looking stuff was a little on the weaker side. And that had people questioning, is that survey data forward looking and do we need to be concerned about that? That's now also turned higher. So I think you're getting just a very clean, strong, positive look from the growth side of the equation. The question with CPI, I think, is after that really strong wages report, if we were to get an upside surprise on CPI, then folks might say, wait a second, is this thing really overheating? And then do we have to price cuts out instead of just pushing them out? And that'll be, I think, a key takeaway from the data this week.
The prices paid element of the ISM was part of that wage growth story as well, I think. I think that got people concerned too. Is it sufficient to tip the scale one way or another tomorrow morning?
It doesn't feel like it. I mean, what the Fed basically told you is the inflation we've seen for the last 6 months is enough or justifies us cutting if it continues. So it does seem like if it's just steady as she goes, then the Fed wants to be cutting rates this year. So I think unless we get something just off the radar a little bit in the data tomorrow, we should just be, continuing on the path that we're on, which is, strong growth data and the Fed likely to cut at some point later this year.
You just flirted with good news is bad news. I'm serious, you did, because there's sort of that underpinning that basically the risk of overheating, then what? Is that negative for stocks?
Not for overheat. No, honestly, no. I don't think it's negative for stocks. This is a nominal growth asset. And we're of the view that if rates cuts are getting priced out because growth data is very strong, then you ought to remain long equity risk. So, I think there are certain areas of the market, certain trades that people have on that are much more sensitive to that rate cut pricing. Small cap equities is a good example. So you can have a period where small cap equities got beat up pretty bad in January and S&P 500 was still up. So I think there are pockets of the market that are more sensitive to the rhetoric you're describing, but sort of index level, we're still comfortable with it.
So you're talking about market-based bets. Market-weighted S&P 500 is the best bet right now at a time where it's very hard to understand when that rotation is going to be triggered?
Oh, you're trying to get me into trouble here, but look, I think from our perspective, we still like S&P equal weight. So we've never been comfortable going down to small cap. We think it has more growth and interest rate risk than you should be accepting. We do think, and we think earnings season kind of drove this home, that we are seeing a broadening out in profitability of the S&P, and that should allow equal weighted S&P ultimately to kind of catch up. Obviously, the last week or so was large cap tech earnings, so everybody was focused on that space. But, our view is coming out of earnings, the story is going to be the S&P is going to grow EPS 10% plus. There's probably 8 sectors that are going to have positive EPS growth, and that allows you to kind of own a broader variety of S&P stocks.
Well, let's go further then. If you're stripping out the big muscle of big tech and going equal weight, beyond big tech, you mentioned a bunch of sectors there. Can you identify a couple where you are super constructive on the outlook for earnings?
Yeah, it's a little tricky there. I'd say if you the difference between equal weight and cap weighted S&P is kind of you're in more industrials and you're in less tech. So as much as we don't want to hardcore fade, that tech trade, I think if you are arguing for a broadening, you need to see healthcare in particular begin to participate, and you need to see industrials kind of participate as well. Healthcare is a little easier. You had really bad comps last year. You were coming off the COVID stuff, and this year it's kind of inflecting higher. Industrials would be a test case. We'll have to see, how that plays out. But I think those are two of the key sectors that are going to be in play.
Didn't hear financials. How complicated is that now?
Financials is a very complicated trade. I would say we're less concerned with large cap financials. It's that small cap regional banks trade that's really come under pressure. I think a lot of folks were really in that trade, as I mentioned, similar to IWM, for that rates cut story. When that rate cut story, went by the wayside, some people took off risk, and then you had the New York Community Bank news. And look, if you're a macro investor and you're investing in regional banks for growth and interest rates and you get a credit risk surprise, I think kind of what you say is it's a little bit above my pay scale, perhaps. I'm not going to be modeling these balance sheets bottom up, so I need to be a little more cautious. So large cap banks, I think that trade can still work. Regional banks, we've never been, super excited about regional banks really since last March, so it doesn't surprise me that people are being a little cautious. But so that's what we'd say. Large cap, okay. Regionals, you want to be a little careful with still.
Taking a step back, and I really love this story, the idea of stocks as the new bond, and forgive me, but there's this sort of question as they start to do more dividend payouts and as a lot of corporate executives start to engage in even greater share buybacks. At what point is this increasingly a dividend play akin to a bond that you're actually getting the potential for 6% yield?
Look, the way the bonds are performing, if I was a bond, I'd want to be a stock. I think you've got it backwards. Look, I think the dividends are really coming up is very interesting. Meta, in particular, last week, I think got a lot of people's attention. Meta introduced a dividend. It's a small yield. That increased the S&P 500 dividend by over 60 cents just by itself. Wow. So the dividend story is definitely, coming into play, particularly if we start to get yields a little bit lower. People are going to be looking at equities and trying to see where can I replicate, that cash yield that I was generating.
What do you think of the Jeff Bezos school of thought unloading $2 billion worth of Amazon shares last week?
I wish I had $2 billion worth of shares to unload.
I like it.
Maybe he should pay a dividend.
First time he's sold stock since 2021.
Yeah.
Noticeable.
It's a question of why now? Is he just planning to buy another yacht? Do you know?
I don't. Maybe he wanted to go. Maybe he wanted to do the Super Bowl and Taylor Swift in the same weekend, and that takes cash.
It's a notable sale. Let's put it that way. Stuart, you're going to stick with us, I'm pleased to say. Here are the scores for you on the S&P 500, totally unchanged. Into the bond market, going into CPI tomorrow morning. Your 2-year down a couple of basis points, 446 on a 2-year. On a 10-year, we're down about 2 basis points to 415. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief. Here's Danny Berger.
U.S. Defense Secretary Lloyd Austin has been hospitalized for the second time in a month. The Pentagon chief was admitted into care late Sunday with an apparent bladder issue. Deputy Defense Secretary Kathleen Hicks has taken over the secretary's functions and duties. The fresh health scare comes weeks after Austin was criticized for failing to disclose that he had been hospitalized on New Year's Day from complications from prostate cancer surgery. Diamondback Energy will buy Endeavor Energy Resources in a deal valued at $26 billion. The company will fund the deal through shares and $8 billion in cash. The deal marks the latest wave of a consolidation in the energy sector after Exxon and Chevron both made major acquisitions over the last 12 months. And Super Bowl Sunday boosted American consumerism, but Monday might be a drag on productivity. Around 16 million people will skip work today because of the event's late finish, while roughly a third will be less productive than usual. That's according to a survey by UKG Workforce Institute. Some solutions to the Super Bowl flu involve having the match played on Saturday or delayed a week to line up with the President's Day holiday next Monday. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. I still don't know why it's not delayed. Just delay it a weekend. Then you can have the Monday off anyway.
Yeah, but I think that people just sort of assume it's like a national holiday. It's the Chinese New Year. It's a national holiday in Japan. It's Carnival in Brazil. Okay. And it's Super Bowl flu day in
have one here.
The United States.
Have it off. Exactly. I think I was one of 2 people that was watching the golf on NBC.
Yes, you were.
I'd love the audience figures on TV just to find out. As the Super Bowl was kicking off, I'm watching the playoff of the Waste Management Phoenix Open. And everyone else is watching
you crushed it.
Football. Yeah. Me and like 2 other Brits who are living in America or something. Up next on this programme, Israel launching more airstrikes in Rafah.
Victory is within reach. That has to be understood. And victory will be the best thing that will happen, not only for Israel, but for the Palestinians themselves. I can't see a future for the Palestinians or for peace in the Middle East if Hamas is victorious.
That conversation is coming up next, live from New York. This is Bloomberg. Republican presidential candidate Nikki Haley about 15 minutes away on Bloomberg TV, a must-watch conversation just around the corner. Equity futures this morning, and good morning to you. Totally unchanged on the S&P 500. In the bond market, down about 2 basis points, 415.21 on a 10-year. Crude lower by a full percentage point and change, 75.96 on WTI. Under surveillance, Israel launching more airstrikes in Rafah.
Those who say that under no circumstances should we enter Rafah are basically saying, lose the war, keep Hamas there. Victory is within reach. That has to be understood. And victory will be the best thing that will happen, not only for Israel, but for the Palestinians themselves. I can't see a future for the Palestinians or for peace in the Middle East if Hamas is victorious.
Here's the latest this morning. Israel launching additional airstrikes in Rafah despite pushback from world leaders. President Biden urging Netanyahu to do more to protect civilians, saying, quote, a military operation in Rafah should not proceed without a credible and executable plan. The EU expressing its own concerns, saying resuming negotiations to free hostages and suspend hostilities is the only way to avert bloodshed. Aaron David Miller, Senior Fellow at the Carnegie Endowment for International Peace, joins us now for more. Aaron, the Israeli leader says that we are very close to victory. Victory is within sight. Do you agree with that?
Well, if you judge victory by the three goals that the Israeli Defense Forces and the Israeli political establishment put out in the first few days of October, which is to destroy Hamas's military infrastructure above and below ground, kill its senior leaders, and redeem all the hostages, I think it's fair to say that, no, the Israelis are not on the verge of what you and I would consider a conventional victory by any standards. I think what the Israelis managed to do in this operation clearly was probably weeks in the planning, provided a huge show of support for a beleaguered prime minister. It's given him additional incentive, I think, to push back against President Biden, and I think it demonstrates his view, I'm not sure it's accurate, that the longer the Israelis can operate in Rafah, the greater the chances that they will destroy Hamas's battalions there and perhaps even free some of the hostages.
President Biden wants to see a credible and executable plan for the safety of those 1 million Palestinians that are now living and have taken refuge in Rafah. How does Israel do this without harming civilians? Because last night we already have seen that that's not possible.
It's hard to know. You're dealing with Gaza, right? Roughly twice the size of the District of Columbia, with, under ordinary days, a population density of some 20,000 humans per square mile. You now have 1.4 million humans sandwiched in an eighth of the area of Gaza, and a population density of anywhere from 120,000 humans per square mile. It's hard to imagine the Israelis evacuating 1.4 million people. They seem to believe that there's an area west of Rafah, roughly 4 miles along the coast, in the Mawasi area. I've been there. It's about 6 miles long. I don't think that's going to answer the mail. So I think it's clear the Israelis are pressing Hamas, and we'll see. CIA Director Burns is due in Cairo to resume negotiations. Maybe, just maybe, Hamas may be under greater pressure to soften its terms on a hostage for prisoner release. But I don't think that's what the prime minister wants, because that's going to involve very painful concessions, which could strain his right-wing coalition.
Where does this leave Egypt? You were part of the government when the Egyptian-Israeli peace treaty was negotiated. How at risk is the 1979 peace treaty between Egypt and Israel, given the fact that if Israel were to do this, they'd have a tremendous amount of troops on that border, which would technically break the pact?
Right. Well, the Egyptians have threatened publicly to suspend the treaty if, in fact, the Israelis launch a massive attack in Rafah. Egyptian sensitivities are clear. They do not want large number of Palestinians, either as refugees or permanent residents, being pushed into Sinai. This is something that most Egyptians share, despite their sentiments for the Palestinians, and it's something the Egyptian government does not want any part of. Hamas, as you know, began as a offshoot of the Egyptian Muslim Brotherhood, and for Sisi, that's a security problem. So again, the Israelis are going to have to make a pretty important calculation here, whether or not they're prepared to risk the U.S. relations with Israel, and certainly Egyptian relations with Israel, if they mount a massive campaign in Rafah. I don't see that campaign, by the way, as imminent.
So just taking a look at the U.S. action in the region, I'm curious how you would view it. Do you think it's been successful? Where has it fallen short?
Look, I think we have to accept one basic truth that is so obvious it escapes people. And I'm reminded of every day when I do this analysis. the two major combatants, Israel and Hamas, have driven this conflict from the beginning. They determine the arc of trajectory. They determine whether it's going to intensify or de-escalate. The role of external actors, even the United States, Israel's foremost ally, is important. But I'm not sure the U.S. is capable to fundamentally alter a conflict with both Hamas and Israel to some extent. On the Israeli side, for Hamas, it's clearly existential. But on the Israeli side, this is a core national interest. And despite the fact that you've got the most right-wing government in Israel's history, I think the vast majority of the Israeli public shares Netanyahu's war aims. As for the regional conflict, I think the axis of resistance, Hezbollah, and backed by Iran, pro-Iranian militias are simply taking advantage of Israel-Gaza to score points and to make trouble where they can. I don't think there's a solution either, by the way, for the regionalization of this conflict. The objective is to prevent, if the U.S. can, a major regional war, which would lead to a direct confrontation between Israel and Iran, ballistic missiles, direct attacks on Iranian territories. The Gulf states would be involved. You'd see rising oil prices, plunging financial markets. The Middle East has never experienced such an event. I'm not predicting we can get there, but it's a concern that it's to be avoided at all costs if possible.
It's certainly the concern. Aaron, we've got to leave it there. Thanks for jumping on with us today. Aaron David Miller there. And what could happen to crude and markets more broadly if you get the conflict I think a lot of people are fearing. Ultimately, though, this is the story. Weekend of October 7th, terrorist attacks in Israel. Crude closed that weekend, 82.79. Opened back up, bit of a bump. Lisa, $76 on crude this morning.
Which defies a lot of expectations. People came on with us and said that they could see oil prices going to $100 a barrel. Key issues. Number one, U.S. production has completely overwhelmed any potential shortfalls anywhere else. But number two, the goal of everybody, at least stated, is to avoid a larger conflict. Everyone keeps saying that. So if you start to back out, it seems like the chances of some sort of cessation of shipments of oil seem somewhat remote. That said, over the weekend and on Friday, there was a pop in oil prices, and there was this thought maybe the U.S. could take greater action in sanctioning Iran.
Stuart Kaiser of Citi is with us around the table. Stuart, I guess the question we're all asking is how insulated these markets are stateside from the conflict taking place overseas.
I mean, I think it's exactly what you all said. It's about the price of oil. You know, I think a lot of investors in the U.S. in particular are saying unless that price of oil rises meaningfully, I'm going to kind of compartmentalize the Middle East, to what's going on there. So I think, if we were to see oil, let's say, rise into the 80s or 90s, then I think people are going to have to do, a process of going back and reading the headlines maybe they weren't paying attention to for a month or so. And those headlines are not going to look too friendly. So I think for now, it's been just treated as an oil trade. And unless that oil price triggers them to be more responsive to it, I think people are willing to kind of keep it at arm's length.
But do you think some risk is already priced in? I always come back to the question of, how low would oil be if there was none of this happening right now in the Middle East?
It's a great question. I mean, there was a period of time immediately after the invasion where you did see, oil volatility, for instance, was quite high, especially relative to other assets. A lot of that's come back out. So it's quite possible with the U.S. producing, 13 million barrels a day or whatever it is, that we would have lower oil prices if not for what's going on. But I would say the price of oil is at a level that most people are saying is manageable for the economy. And that's kind of how we're proceeding at this point.
It always sort of makes me scratch my head when people say there's a lot of geopolitical risk and we have to price it in. How, right? I mean, what are we talking about? We're talking about a potential war in the Middle East. We're talking about a potential really contentious, volatile presidential election season that's going to take forever. How do you trade this?
Look, I think risk pricing wise, like right now, you're seeing more risk priced actually into Asian equities right now from a volatility perspective. So people seem a little bit more concerned with the situation in China than they do in the Middle East. Tactically speaking, you did get some risk priced, via oil. I think, probably what folks are doing right now is they've got some sort of, deep out of the money sort of Middle East tail risk in their, or geopolitical tail risk in their portfolio and are otherwise, operating, under normal conditions. Look, the S&P is up 5% year to date. And I think what people realized last year is if you obsess about the risks and you stay out of the market, you have the potential that the market's going to run away from you.
Europe's a fantastic example of that. Never mind the Magnificent Seven and the S&P 500. There were plenty of reasons to be concerned about Europe. A war taking place in Ukraine, a big slowdown, a disappointment in China. In fact, I'd go back to last year. I told you, let's play that game again. Play it all the time and talk about how wrong we all are about everything. If I told you how much China would disappoint reopening, how much they would underdeliver the stimulus so many people anticipated, would you have had the DAX up 20% year to date last year? 20% gains.
It doesn't really comply with sort of these big macro ideas, which is the reason why I think a lot of people are kind of in this malaise. I don't know, maybe you could tell me better than I could characterize this, but doesn't it feel like people are kind of in a bit of a malaise right now?
I mean, John obviously did not buy the DAX last year. I think we could all agree on that. Look, I did. Look, you went through a major crisis. I do think the market is still working through some scar tissue, from what happened the last couple of years from the inflation spike and stuff like that. And it's definitely kept people out of the markets or in the markets in a very conservative and kind of understandable way.
I'll tell you this, I wish I had. All right. Stuart, it's good to see you. Stuart Kaiser there of Citi. Coming up on the programme, Republican presidential candidate Nikki Haley as she continues challenging frontrunner Donald Trump for the nomination. That conversation just around the corner. Equity futures on the S&P 500 are unchanged going into CPI tomorrow morning. Yields are a little bit lower on a 10-year, down 2 basis points, 4.15. From New York, this is Bloomberg. We are about 2 hours away from the opening bell in New York City. Equity futures on the S&P 500 totally unchanged on the S&P. On the Nasdaq unchanged as well. The small caps on the Russell positive here by about 1/3%. That's the market. Here's the politics. Donald Trump on the cusp of clinching the GOP nomination after wins in Iowa and New Hampshire. Nikki Haley looking to close the gap in her home state of South Carolina. The former UN ambassador, Nikki Haley, joins us now for more. Ambassador Haley, thank you very much for catching up with Bloomberg this morning. If you'll allow me, I'd like to go straight to some of the polls because I think you find yourself in a really peculiar position. Head to head with the sitting president, you dominate him. Within your own party, you're struggling. The latest poll from the Washington Post, Monmouth University, shows 58% of South Carolina voters support Trump compared to 32% for you. So my question would be, how much daylight is there between what your party wants and what you think is good for it?
Well, first of all, I'm really proud of what we've done. We had 14 people in the race. We've defeated a dozen of the fellas. I just got one more I've got to catch up to. Everybody said we wouldn't be able to do it. We started with 2% in Iowa. We ended up with 20%. We went to New Hampshire. We got 43% of the vote. We increased 25 points in the last 3 weeks of New Hampshire. This race is still very much moving. We are going to continue to close that gap in South Carolina as we head to Michigan and Super Tuesday. Remember, 70% of Americans don't want to see a Trump-Biden rematch. I am pushing through to make sure they have a voice. That's what we have to do. That's what matters. You've got, a decision whether to keep more of the same or whether to go in a new direction. More of the same is not just Joe Biden. More of the same is Donald Trump. And we've got to stop the chaos. We've got to stop the division. But more importantly, we've got to get our domestic issues on track. We've got to get our national security on track. And we've got to get the American families back on track.
Well, let's kick it off with some foreign policy. So you voiced opposition clearly to Trump's remarks on NATO over the weekend. I'm struggling to find more than a handful of Republican senators who agree with you. Is there any evidence that Trump's thinking is unpopular with GOP voters?
Well, it's not to go and blame the voters, and it's not to go and blame the American people. I've always said it's important for Joe Biden and Congress to tell the American people why they should care, to give them the other side. And you don't hear that. The other side is that NATO's been a 75-year success story. We have not had war in the region. And if you look, Russia has never invaded a NATO country. They've invaded Georgia. They've invaded Ukraine. They've invaded Moldova. So we want to make sure that, yes, do we want NATO to pay more? Of course we do. But the last thing we're going to do is side with a thug. Keep in mind, Putin kills his opponents. Keep in mind that he has arrested Evan Gersovich, who's been sitting in jail just for doing journalism. Keep in mind that this is a man who has wanted to destroy America and defeat America for years. I dealt with Russia every single day. It is a mistake for Trump to side with Putin over our allies. We needed a lot of friends after 9/11. We better remember that. But it takes a friend to get a friend.
Ambassador Haley, I'm sure you've seen the comments from the likes of Lindsey Graham and Marco Rubio. When it comes to NATO, do you feel like you're potentially out of step with members of your own party?
It's not, the goal is never to follow the polls. The goal is to make sure you communicate what's right. We need to make sure that we have an alliance that's strong. Our whole goal is to prevent war. That's the main thing. I mean, you look at Russia right now. The reason people should care about Ukraine is because, one, it's a pro-American, freedom-loving country. But two, listen to what Putin said. Putin said once he takes Ukraine, Poland and the Baltics are next. Those are NATO countries. That immediately puts America at war. This is about preventing war. This is about keeping an alliance strong. This is about bringing more friends in, not pushing friends away. Donald Trump doesn't get that. And that's what will creep us into war. We can't have that. And so our goal is not to go and blame the American people for feeling the way they do. It's to make sure we get our message out on why they should care and how this is in the best interests of America. And for those politicians who are refusing to say that, that's a disservice to the people that they serve.
If the goal is to bring more friends in, would you agree that President Biden has done a good job in expanding the NATO alliance?
Well, I think, first of all, I think that he understands the importance of NATO, but he doesn't understand the importance of preventing war. He could have prevented Putin going into Ukraine. All of this wouldn't have happened if we wouldn't have had the debacle in Afghanistan. I mean, think about the fact that we left Bagram Air Force Base in the middle of the night without telling our allies who stood shoulder to shoulder with us for decades because we asked them to be there. Think about what that told our friends. More importantly, think about what that said to our enemies. So there's no surprise that Putin went and invaded Ukraine. There's no surprise that we're seeing Iran push its terrorist proxies to do evil around the world. There's no surprise that Hamas invaded Israel. There's no surprise that China is doing surveillance and intimidation over Taiwan. They see that the U.S. is weak and they don't trust it. And the fact that we are watching Joe Biden in decline is not helping that. Russia, China, and Iran are watching every day the decline of Joe Biden. This is bigger than a party. This is about the fact that we've got to look out for the national interests of our country. And that's when you put all of this aside and say, what do we need? We don't need two 80-year-old candidates running for president. We need someone who can serve 8 years, disciplined, strong, no volatility, no drama, no vindictiveness. Just get the job done for the American people. That's what I'm trying to do.
Well, when it comes to mental acuity, I know you want to make a standard that they have to take these tests. You said you're willing to take these tests. Do you expect Biden or Trump to take a mental acuity test before November?
I expect that if you look at the fact, this is just a fact. There's a reason pilots can't fly after the age of 65. There's a reason you have to get out of the military after a limited age. There are a lot of industries that do that because it is fact. You are in decline. You look at Joe Biden 2 years ago, very different than what you see Joe Biden today. You look at Donald Trump in 2016, very different than what you see today. Donald Trump the other day went on 3-4 times saying that I should have had security at the Capitol on January 6th. I never had a job in D.C. I never was in charge of security. He was confused. That is what happens. What I am saying is I don't care if you do mental competency tests for 50 and up. But these are people making decisions on our national security. These are people making decisions on the future of our economy. We need to know they're at the top of their game. This is not about whether you like them or they hold a baby well. This is about the fact that we have serious issues in our country. Our country is in disarray and the world is on fire. And we can't go through 4 more years of chaos. We won't survive it.
Ambassador Haley, you point out a number of gaffes, not just from the former President Trump, but also current President Biden. At the same time, they're still beating you in polls when it comes to Trump. Even the FT over the weekend, when it comes to handling of the economy, you're trailing Biden. Why is that?
Well, first of all, if you look at the general election polls, you see that I do defeat Biden by almost 17 points. You can look at the Marquette poll that just came out last week. I defeat Biden in Wisconsin by 15 points. Trump doesn't defeat Biden. And we have to look at the fact that if we go and all the swing states, I defeat Biden. And if I win by double digits, do you know what that means? That means you go into D.C. with a mandate to stop the wasteful spending and get our economy back on track, a mandate to get our kids reading again and go back to the basics in education, a mandate to secure our borders with no more excuses, a mandate for law and order back in our cities, and a mandate of a strong America that prevents wars that we can all be proud of. That's the goal of where we're trying to go. We've got to get past this partisan, it's got to be him or him. I think the problem is both of those men. You look at it, whether it's these court cases where they had national security documents they shouldn't have had. If you've ever had a job that dealt with any sort of security documents, you know that they are handled with extreme care. The fact that both of these gentlemen were so arrogant to have those documents bragging around about them or having them in a garage tells you this is more about them than it is about the American people. That's the focus. We've got to get this back on the American people and stop getting it on these two men who are refusing to give up their power.
We can focus on that right now. Ambassador Haley, you mentioned the economy. Let's talk about it. Last summer, you spoke to this network about ways to combat rising debt. I've got the transcript in front of me. My colleague Joe Matthew asked you, how would you manage the entitlements to try and get our arms around soaring debt? Your answer: any candidate that says they're not going to touch entitlements, they're basically going to go into office and leave America bankrupt. One option you offered: we change retirement age to reflect life expectancy. Your original answer is now part of Trump campaign ads. Is that still something you want to do?
Well, first of all, that's not what I said. What I said is we should not ever take away from those who have invested in and those who have been promised. America should always keep their promises. I said we should go and change the rules for those in their 20s. That's the problem. Those in their 20s, like my kids, for them, we should change the retirement age to life expectancy. Instead of cost of living increases, we should do increases based on inflation. We should cap the benefits on the mega wealthy, and we should expand Medicare Advantage plans. What Donald Trump wants to do is he doesn't want to touch it so that when Social Security goes bankrupt in 10 years, everybody gets a 24% cut across the board. That's not how you handle a problem. I'm going to count it. The thing you do is you get in front of the problem. When we make those changes, that's when you start focusing on what it takes to make sure not only does everybody who've paid in keep what they get, but you make sure that our kids will actually have something when the time comes for them as well. We have to take that seriously, and we have to stop having Congress raid the Social Security accounts. Right now, they're raiding all of those accounts instead of stopping the wasteful spending. We'll stop the spending, stop the borrowing, eliminate the pet projects, and I'll veto any spending bill that doesn't take us back to pre-COVID levels.
Ambassador, do you still think 65 is way too low when it comes to retirement?
I think it depends. We need to go and look at the numbers and see exactly where it should be. I think right now we do know that people are living longer. What the age should be depends. But for everybody that's paid in the system, the age is 65. That will stay 65. For those in their 20s, that's where we're going to have to go and look and say, what's the right age for us to do that? We can solve this problem. People don't have to live in fear that they're going to lose their Social Security, but we need to be honest with them. Communicate to them that Social Security will go bankrupt in 10 years. Communicate to them that Medicare will go bankrupt in 8. And let them know that we're going to find a way to make sure they keep what they have, but we're going to have to make changes going forward so that we can start to make sure these things are solvent.
In 10 years, just changing some of the respect to 20-year-olds isn't going to necessarily change the equation financially in terms of making Social Security more sustainable. So what else could you do in the near term to make this sustainable?
Well, right now, Joe Biden and Donald Trump are saying they're not going to do anything, which means you're going to have a 24% cap, a 24% cut in 10 years. At least I'm willing to do something about it. At least I'm willing to tell the American people the truth, that there is a problem and that we're going to fix it. So the thing is, you start with that. You also start with cutting out the wasteful spending that's happened from Republicans and Democrats. We saw that $2.2 trillion COVID stimulus bill that passed with no accountability, that's now expanded welfare, that's left us with 80 million Americans on Medicaid, 42 million Americans on food stamps. That's a third of our country. And instead of Republicans doubling down and trying to make something right, they opened up pet projects and earmarks for the first time in 10 years, pushing through 7,000 of them last year. You've got to stop that. The other ways we're going to do it is we're going to take as many programs in the federal government as we can and pass them down to the state level. That will dramatically reduce the size of the federal government, but it will empower people on the ground. Think education, think welfare, think healthcare, think mental health. When you go and cut those strings and allow that to go down to the people, you're reducing the size of the bloated government we have. Everybody loves to talk about how great the economy was under Donald Trump. Well, yeah, it seemed great. But at what cost? Well, he put us $8 trillion in debt in just 4 years. Joe Biden went and doubled down and put us even more in debt. That's not how you fix the economy. That's how you go and leave younger generations in a situation they'll never be able to pull out of.
Meanwhile, Donald Trump is talking about heavily tariffing Chinese goods, potentially up to 40%. Do you see this as one viable way to raise money?
Absolutely not. All that does is raise taxes on the American families and our small businesses that we need to be taken care of. It is ludicrous that he wants to go and raise those tariffs to everything that we import. That's going to affect American families on anything from baby strollers to appliances. Every American family will see at least a $2,800 increase in their taxes. Not only that, not only does he want to cut Social Security by 24% in 10 years, he wanted to raise the gas tax by 25 cents per gallon in 2018. He doesn't understand the value of a taxpayer dollar. He doesn't understand that you don't go in debt. You don't tax the American people. You don't go and take care of big corporations. You take care of small businesses and American families by making sure they have more cash that they can spend. That's been what's lost not only in Donald Trump, but in Joe Biden and in every member of Congress.
Ambassador Haley, given that you seemingly consider, and many others do too, that a tariff on China is a tax on American consumers, would you consider repealing existing tariffs on Chinese imports?
China's different. Now, when you talk about Trump wants to do tariffs across the board from every country. China, we have to deal with differently. We have to understand China has been preparing for war with us for years. That's not an exaggeration. They're already here. We know that. They bought 400,000 acres of U.S. soil, most recently near Grand Forks Air Force Base, where our most sensitive drone technology is. They're putting millions of dollars into our universities, stealing our research, and spreading Chinese propaganda. They've got Chinese police stations throughout our country. We know they had the Chinese spy balloon that was doing surveillance over our country that now connected with a U.S. internet company and sent that surveillance to China. They're building up their military, threatening America. What we need to do is when we look at China, you look at it through a national security lens. You look at it and say, if China pulled the rug out from under us tomorrow, would we be ready? Think about what happened during COVID. Everybody was told to wear a mask. Who made the masks? China did. Everybody was told to take a COVID test. You turned it over. It was made in China. Go into your drugstores right now. All of those medications are made in China. We've got to focus on what do we do to change that narrative, to make sure that the American people are not dependent on China, but we move that trade either to where we make it in in America, or we go and we make it with our allies and our friends.
Ambassador, just quickly, if you really think that neither candidate, who currently are the frontrunners, is a good option and could potentially be really harmful for this country, would you consider an independent run if you didn't win the Republican nomination?
I'm a Republican. We can win as a Republican. We moved 25 points in the last 3 weeks of New Hampshire. We're closing the gap in South Carolina. We are on a bus tour now. We're anywhere and everywhere, and you will see the numbers are very different than what y'all are reporting today. We have a country to save. We've got one chance to get it right. We've got to listen to 70% of the American people that don't want Trump and Biden. You don't fix Democrat chaos with Republican chaos. You look at the fact that Biden has had all of this diminished capacity. Democrats better start looking for another candidate. My prediction is they will. You look at Donald Trump. Look at the losses we had just this week. He went and he lost the fact that we lost an Israel bill. We lost a bill on the border. He lost immunity for his court cases where he spent $50 million in campaign contributions on personal court cases. The RNC is broke. The RNC party chair lost her job. Donald Trump has his fingerprints on all of that. There is no way Republicans defeat Joe Biden or Democrats with chaos like that. We've got to get rid of both of them, get a new generational leader, and get America back on track. Go to NikkiHaley.com, and that's how we'll get it done.
I expected that plug in there somewhere, Ambassador. You've been very generous with your time. I just want to fit in just one further question. The threshold for you to stay in this race after South Carolina. You've been quite transparent about that over the last couple of weeks. Has that changed?
Not changed at all. I mean, if anything, we feel the intensity of people coming out to vote that have never voted before. We feel the fear that people have about the fact that this is where it could end. And think about what everybody's saying. The Republicans tried to push me out and say that Donald Trump needed to be the presumptive nominee. If I were to get out today, that would be the longest general election race in history. We don't do coronations in America. We allow the American people to vote. Let the people vote. We'll go into South Carolina. We'll close that gap. We'll go into Michigan. Then we'll go into Super Tuesday. This is about making sure that Americans have a choice. In a general election, Americans are given a choice. In a primary, Americans make their choice. This is when Americans make their choice.
We look forward to catching up with you after the people of South Carolina make their choice. Nikki Haley, thank you. Nikki Haley there, the former UN ambassador, and Annmarie, presidential hopeful for the Republicans.
Well, she's going to have to get that bus out all over South Carolina because Real Clear Politics has her trailing Trump 30 points. Although what she's talking about is the fact that you see it in poll after poll. Americans don't want a rematch of 2020. And I'm not talking about the Super Bowl. I'm talking about Trump v. Biden.
I'll finish where we started. I think it is a really peculiar position to be in, to dominate the sitting president like she does in the polls, and then to be so far behind in her home state against the former president.
Which is why it's interesting to me that she still is very much a loyal Republican, despite the fact that the Republican Party is basically rejecting her and choosing Trump.
And you've been asking a question. You make an independent run? No, I'm a Republican. But it begs the question, are you the Republican that this party has now become? I think that's very different.
And are the parties becoming representative of the majority of Americans that probably sit somewhere in between the polls?
We've got to take a quick commercial break. We'll continue this conversation. Equities on the S&P 500, totally unchanged. Live from New York, this is Bloomberg. Live from New York City this morning. Good morning. Equities unchanged on the S&P 500. Equities going absolutely nowhere. Under surveillance, Treasury yields touching year-to-date highs.
The underlying dynamics point to higher yields, so we wouldn't be surprised to see a test of 450 at that level. We go +2 long overweight duration. And then the high of last year was 5%. I don't believe we go above that, but do we go north of 250 or higher than 450? Yes, it's a possibility.
Here's the latest this morning. 2- and 5-year yields touching their highest levels since December as investors question whether the economy will require as many cuts as the market is pricing in. Gennady Goldberg of TD Securities quoting NSYNC, writing on the first rate cut, I'm not singing this, it's going to be May. While the March meeting is not completely discarded, Chair Powell all but closed the door to that possibility. We continue to judge the May FOMC meeting as the most likely for the Fed to start easing policy. Gennady Goldberg joins us now for more. It's going to be May. Let's talk about why it might not be June or later on this year.
Well, generally, I don't think they particularly care. I mean, if you ask Powell, in reality, do you care whether it's May, June, or July? He'll kind of give you a quizzical look and say, well, look, we don't care as long as we start. We know that they have to start relatively soon because real rates are quite high. So we know that, you're probably going to see some over-tightening if nothing else changes. So in our minds, you're probably going to see a cutting cycle start in May. By May, they should have enough evidence specifically on inflation. And I think that's really the key here, is the inflation side, not really the growth side of the economy.
I keep going back to this. Savita Subramanian over at Bank of America saying if the Fed doesn't cut rates at all this year, she could still see equities eking out a gain. Do you see the same in risk assets within fixed income, that essentially good news is good news? Strength will be met with more gains for risk assets regardless of what the Fed does?
So that kind of thinking gets me a little bit nervous. I think everyone's quite expectant of, either we get good news or we get good news with the Fed rate cuts. The problem is nobody's really anticipating any downside risks. I mean, if you do see the economy slow down and the Fed is refusing to cut rates, that could be a pretty toxic scenario for risky assets. If you're seeing the economy do okay, and that's why the Fed is not cutting, perhaps you can see stocks eke out a gain. I think a lot of that recent move higher in equities recently has actually been driven by expectations for rate cuts and the fact that the Fed's going to be easy.
So are you saying this is actually really compelling, that people have not priced in the idea of rate cuts due to actual weakness? Do you think that that's a possibility? Is that something that you're sniffing out?
I think so. I mean, if you're really thinking rate cuts because of a harder landing, that's not an equity positive story. I think what you're seeing right now is basically every single investor pricing in a soft landing, which again gets me quite nervous. Some of the recent data has been solid, but what we know is, things like labor market data are fairly lagging. We do know the Fed is keen to cut. Why? Because they know that the longer that real rates stay high, the more likely you are to see a bit of an accident and a harder landing than anybody expects.
You've got a May start. I think it's that 250 basis points of cut you expect by Q1 2025 that is like the standout call here. That can't just be an inflation call. Is that a hard landing economy call?
We are looking for the economy to slow down. I think the timing of that is getting a little bit difficult just because of the numbers you've seen for payrolls, for example, in December and January. Right now, we're debating whether, that's likely, whether that's likely a little bit later in the year. And I think the problem is, markets have been thinking about this for quite some time. They've been basically trying to figure out when the economy is actually going to slow down and whether we get that soft landing or not.
L. Davis Abimo, in that clip we played at the start of this segment, was talking up 450 on a 10-year. Clearly, you're on the other side of that. What are you thinking about?
I'd love 450. I'd love to go long at 450. I really think most investors at this point are looking for 425 to 450 to actually get into some longs. And, I've been on the road quite a bit recently talking to clients. That seems to be general consensus. You definitely go long at 450, which is why I think we're going to struggle to get there. We're probably going to stop a little bit short because people are going to be adding at 425.
Bob Michael at JP Morgan Asset Management said almost exactly that. Gennady, it's good to see you. Always is. Thank you, sir. Gennady Goldberg there of TD Securities in the third hour of Bloomberg Surveillance. Lee Ferridge of State Street. Matthew Bartlett of Derby Field Advisors and Torsten Slock of Apollo. That and a whole lot more. Live from New York City, equities going absolutely nowhere. The third hour of Bloomberg Surveillance up next.
The Fed has all the evidence they would need to either cut or stay put.
We think the Fed could probably cut rates 4 or 5 times this year.
We are talking about rate cuts. It's a question of when.
As you see from the policy speak, there is no hurry for cuts anytime soon.
People talking about the resiliency of the U.S. economy. We think that will continue and push out when the possible Fed easing cycle starts.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance, the third hour, alongside Lisa Abramowicz, together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500, totally unchanged. 5 weeks of gains on the S&P for 14 weeks out of 15. This equity market has rallied. Just amazing, Bramo, to see it continue going into CPI tomorrow morning.
Climbing above 5,000 for the first time, or maybe limping above. And I think that maybe is the way to put it, because right now, it's not exactly as if this is just some sort of rip-roaring, enthusiastic scream from equity investors. Instead, this is the Magnificent Seven crushing it in terms of profitability, and the rest of everyone else just kind of, carrying along behind them.
The fact we're even limping forwards, I think, is impressive given what we've seen in the bond market. The 2 years sold off. Yields are up last week by more than 11 basis points, so another double-digit gain there on the front end of the yield curve, off the back of really robust data. There seems to be this comfort that this strong economic data won't lead the Federal Reserve to do more, and ultimately won't lead to derailing the disinflationary progress we've made over the last 6 months. It's the last point that gets a little bit more fragile. We were speaking to Stuart Kaiser of Citi a little bit earlier this morning. He was basically saying the CPI print tomorrow and the one afterwards could tip the scale in either direction.
Given the fact that people have a base case of this Goldilocks, but the overheating part might just sort of take front and center, here is the issue. If the Fed delays Fed rate cuts simply because there is too much strength, that is a good thing for risk assets. And that's what we hear from person after person. Gennady saying the same thing. If the Fed cuts rates more aggressively because of true weakness, and that comes with some of the inflation that some people expect, that's a recipe that's a whole lot harder for people to stop.
Well, if TD is right, if TD and Gennady Goldberg is right, that we're going to get 250 basis points of cuts between May and the first quarter of next year, that's got to be more than a disinflationary story. Surely that's a story of much, much softer growth.
Which is exactly what he was laying out, and it's something that approximately nobody is betting on. And this, I think, is really the key, is how much enthusiasm and base case of perfection of people really baked into the cake.
CPI report tomorrow morning, 8:30 Eastern Time. We need to talk about the politics as well. Here's the latest poll for the race to become the Republican nominee in the election later this year. The Washington Post Monmouth University poll shows 58% of South Carolina voters support Trump, 32% for the former UN ambassador Nikki Haley. Annmarie, in her home state. We caught up with Nikki Haley about 15, 20 minutes ago. The question we started by asking, I think, is the right one. I think we asked basically 15 different versions of it. How much daylight is there between what your party wants and what you think it needs?
Well, when you look at the polls, there's a lot of daylight, right? Because she's struggling to get the base, which Trump continues to have this absolute hold on. And then you look at NATO, and this is something she's very comfortable discussing given her time as ambassador of the United States at the UN under the former president. And when you hear what some senators are saying after the former president came out over the weekend and said, if you're delinquent and you're a country that says Russia rolled in, he said, I would tell Russia to do whatever the hell they want with you. Senator Lindsey Graham told the New York Times, I don't even know why you're asking me about this. This is what Trump does. Marco Rubio, another foreign policy hawk, says, well, this is how Trump communicates. She says it's not right. And she's equating what Trump is talking about is more of this soft language on Putin, who she called in our interview a thug.
The former president's comments over the weekend speaks to the increasing preference for isolationism in the Republican Party. And you can see it, poll right in front of me, Morning Consult. A record 51% of Republican voters favour greater isolationism in US foreign policy. Lisa, that number is climbing. So once again, in some ways, Nikki Haley finding herself out of sync with where the party is heading.
Well, running as a general election candidate in a market, in an election that really still is run by the parties that have different factions and different majorities, which raises the question, why is she continuing in that party if it is essentially rejecting her? And she just said she is going to continue at that party. But this is the issue, right? How do you run as a general election candidate at a time when you are not going to get chosen as your party's nominee?
We'll play you more of that conversation a little bit later this hour. Here's the stage right now. This is how we're set going into the opening bell, about 1 hour, 25 minutes away. Equity futures are totally unchanged on the S&P 500. Yields are down about 3 basis points or so, 414.82 on a 10-year. In foreign exchange, the euro a touch weaker, dollar stronger, 107.72. Coming up this hour, Lee Ferridge of State Street on why January's CPI report could be the last upbeat inflation print. Matthew Bartlett of Derby Field Advisors on the 2024 GOP race. And Torsten Slok of Apollo on why he sees an increasing chance of a hard landing in the US economy. That's coming up a little bit later. We begin with our top story this hour, the S&P 500 hitting a new record high ahead of tomorrow's CPI report. State Street's Lee Ferridge saying this: risk to tomorrow's CPI report actually lie to the downside. However, we're starting to see some price pressures pick up in February. It's too early to say for sure, but it could be that the January data is the last month of better than expected inflation news. Certainly recent data on wages and services prices paid should cause some increased concerns. For now, however, it looks like the good times can continue to roll. Lee, I'm pleased to say, joined us now for more. Lee, let's get into it and talk about your expectations last year, looking out to this year. You were talking about a stronger economy. It's what you were anticipating. Lee, why was that when many others are looking for that deceleration, perhaps towards recession?
Because I think people underestimated the US consumer. I think people underestimated the level of excess savings. They underestimated the power of the US mortgage market with 30-year fixed rate mortgages. And I think they also underestimated the impact of demographics on the labour market. We have a shortage of workers, and we're seeing that coming through in wages. So you have homeowners are not really impacted by higher rates because they've got 30-year fixed rate mortgages. Big contrast with the rest of the world. You have excess savings still from the pandemic, running out, but still there. And then you have this labour market where we still see tightness.
Lee, you didn't underestimate how resilient this economy would be. Ultimately, other people did. Are you underestimating how resilient this equity market might be in the face of that?
I think, because I feared, my view last year to some extent was, look, the economy's going to be better, the Fed's not going to be cutting as much, and that's going to be bad for equities. I think where we've got into over the last sort of month or two, certainly this year, is, look, we're pushing back to start the rate cuts. We're not removing them. And I think that's the important thing for the equities. There's still this belief that we're going to get this series of rate cuts. It's just they're going to come later. But they're coming later because the economy is stronger. That's a good place to be for risk assets. You've got better economic data. We've still got the prospect of rate cuts coming up, but inflation is coming down. That's a perfect pro-risk scenario, and that's what we're seeing so far this year.
Is risk Mag 7 or is risk small caps?
I mean, so far the equity outperformance this year, if you look at an equally weighted S&P, it's actually flat this year. So it's Mag 7. It has been for a while. We know that. We did November, December. We did start to see the broader market go up, but that coincided with long end rates coming down. When long end rates go up, which is what we're seeing now, it becomes a Mag 7 story rather than a broader market story, and that's what we've seen this year as well. If you look at the equally weighted S&P, November, December were great as rates came down. When we're going up, it's flat.
So what are you betting on? That this is going to continue the same kind of trend? Are you going heavily into the U.S., in particular the market-weighted S&P 500?
Yep, I think it continues. Look, as I said, I think the inflation news is going to be okay for now. I think the growth news is going to continue to be good. So, look, no one's really worried the Fed are going to start hiking again. We're going to keep that prospect of rate cuts out there. Second half of the year, it becomes trickier. Look, first half of the year, I think we're fine. Second half of the year, I start to worry. Base effects and inflation change. Which that pressure in the labour market is still there. I worry about the housing market. We keep expecting that we're going to see the inflation impulse from shelter come down. The housing market is picking back up. We have an inventory problem in the US. Mortgage rates have started to come down a bit. We're seeing on the weekly applications that people who were on the sidelines the last couple of years are coming back. And yet, people who've locked in their mortgage at 3% during the pandemic, they're not moving. So we have an inventory problem. House prices are going back up. And I worry that shelter is actually going to be a positive impulse for inflation in the second half of the year.
Lee, I'm struck by what Julian Emanuel of Evercore ISI wrote over the weekend. He said, remain invested defensively. Valuations can run further, yet momentum markets end without warning. When you talk about the end of momentum, you're talking about a very different scenario than Gennady Goldberg was talking about with weakness in the economy. You're talking about unexpected strength in inflation, a reinflation. How do you sort of hedge against that type of scenario, given that the polls are so different from one another in terms of outcomes?
I mean, it's difficult. I actually think you play it through short duration. I agree. I think you mentioned earlier 4.5% on 10 years. I think we do get there. I think we do get to 4.5% on 10 years. So I would be short duration here. That fits with the story of better economic growth, pushing out the rate cuts. And if inflation does come back more meaningfully, I think you're going to see that curve steepen up. So, for me, I would be short duration here. I honestly think we'll see 4.5% before mid-year.
Lee, everyone's talking up this wall of demand. When we were at 5% on a 10-year and 5.25 or whatever on a 2-year back in October, no one wanted it. And now we're down to the 4s. Apparently everyone wants it, and you're back up to 4.50 and everyone's going to pile in. Do you see it the same way? Or do you see this market actually just swinging back to where we were in October, where when people start to see yields go higher, they don't come in, they actually run in the other direction?
Yeah, exactly. It's all very well to say, well, when we get to 4.5, I'm definitely going to be buying. And then if you get to 4.5, you're like, oh, well, the data's actually strong, and the inflation data might be coming back. What was the Mike Tyson quote? Everyone's got a plan until they get hit in the face. I think that's the sort of 4.5% on 10 years. Yeah, I'll buy it when we get there. Let's see when we get there, because then you might say, 4.75.
Yeah, 4.50 is a right hook, all right. Lee, thank you, sir. Lee Ferrich of State Street. Lee, appreciate it. Lee's right, Bramo. I mean, I think we're both on the same page here. It's so important. The psychology of markets. You get to 5 and climbing, and everyone's like, whoa, no thank you. You drop to 4.50 and you're dropping down towards 4%. Everyone's like, yeah, it's time to pile in. Give me 4.50, I'll be ready to buy. But to Lee's point, if you're backing up to 4.50, the economy's getting better, inflation pressures are still sticky, and you're sitting there and you're thinking you're going to buy, or you're waiting for 4.75 and maybe even 5 around the corner.
It's a question of momentum, right, on the other side. But you raise such a good point. I love how this sort of is phrased, that markets are the only place where when it's on sale, you don't want it, and when it's expensive, you want to pile in. Here's the issue. When do we start worrying about the deficit? When do we start worrying about interest payments, especially given the fact that higher interest expense actually begets more problems because it makes it harder for the U.S. to pay it back? Then when do we care about supply? Or is this just basically something that people are going to put in the back burner? Honestly, it's a very good question. Price sets narrative. And if the narrative shifts, it can keep going for a long time.
The equity market's like a used car salesperson, okay? When you get cut too much, you start to think, is there something wrong with it? Is there something wrong with it?
Completely.
That's how that works. Equities right now on the S&P, totally unchanged. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Israel launched a series of airstrikes on the city of Rafah in the southern Gaza Strip early Monday. Israeli military says that the overnight mission freed 2 hostages. The strikes came after President Biden urged Israeli Prime Minister Benjamin Netanyahu to do more to protect civilians. Over 1 million Palestinians have fled to Rafah since the start of the war. That's about half of Gaza's total population. President Biden called out major snack brands over shrinkflation ahead of the Super Bowl. He didn't name specific companies, nor did he offer a solution to hold them accountable for selling product at a higher price.
Some companies are trying to pull a fast one by shrinking the products little by little and hoping you won't notice. Give me a break. The American public is tired of being played for suckers. I'm calling on companies to put a stop to this.
Even as inflation appears to be slowing, the economy remains the top issue for many Americans heading into the election. Germany's market for office buildings is suffering its sharpest drop in 2 decades. Prices tumbled 13% in the fourth quarter. Higher financing costs and a slow return to office contributed to the downturn. The outlook, though, isn't much better, with further declines projected for the start of the year. That's your Bloomberg Brief, John.
Hey, Danny, thank you. Up next on this program, Nikki Haley firing back at Trump's NATO comments.
NATO's been a 75-year success story. We have not had war in the region. And if you look, Russia has never invaded a NATO country. I dealt with Russia every single day. It is a mistake for Trump to side with Putin over our allies.
That conversation up next. One hour and about 15 minutes away from the opening bell. Equities unchanged for much of the last 2 hours on the S&P 500, which is amazing, really, given the fact we're at all-time highs with CPI just around the corner, sort of treading water. Yields are lower by 3 basis points on a 10-year, 4.1482. Under surveillance this morning, Nikki Haley firing back at Trump's NATO comments.
NATO's been a 75-year success story. We have not had war in the region. And if you look, Russia has never invaded a NATO country. Do we want NATO to pay more? Of course we do. But the last thing we're going to do is side with a thug. I dealt with Russia every single day. It is a mistake for Trump to side with Putin over our allies.
It's the latest this morning. Haley looking to gain ground on the former president in her home state of South Carolina ahead of that state's primary on the 24th. The latest poll showing her trailing Donald Trump by around 30 points. Matthew Bartlett, Republican strategist and principal at Derby Field Advisors, joins us now for more. Matt, it's great to catch up, sir, as always. In some ways, Nikki Haley and the campaign over there just seem like they've got the sequence back to front. They seem to be doing really well on the national stage against Biden and really poorly in their own party against Trump. And you can't get to one without securing the other. So how are they going to turn this around?
Well, first off, amazing interview. You come on surveillance, might be early, but you better bring it. That was more substantive than I think than we've seen from Trump or Biden maybe in the past 9 months. Went all around from the political reality to the really critical issues of the domestic situation as well as, the matters of war and peace internationally. Nikki Haley is espousing what seems to be a very appealing message to a majority of Americans. U.S. leadership, fiscal stability, free trade, economic growth. Yet she seems incredibly out of line and out of touch where the base primary voter is, and that's a problem.
Matthew, when you look at the Republican Party, though, Trump has a grip on that base. It's about 30%. Why is the remainder, given the fact that we have a number of everyone basically dropping out, you think of DeSantis, Pence, etc., why was she unable to get the remainder of that party in the primary?
It's a great question, Annmarie. I would just say that Donald Trump has been the political identity of the base for the better part of a decade now. And they like the attitude. They like the swagger of the former president. I think there was probably maybe a year ago some questions around his electability. Even Trump voters are happy to admit that he steps on himself quite often. Yet what have we seen for the past 6 months? Head-to-head polling where former President Trump is beating current President Biden in many of the swing states. That has done nothing but embolden his message, empower his voters, and really make this just have a psychological effect that the general election rematch is a foregone conclusion.
She's not just out of step with members of her own party. She almost in the last 24 hours feels like she's in step with the Biden administration. When Trump made those comments, Andrew Bates from the White House came out and said, encouraging invasions of our closest allies by murderous regimes is appalling and unhinged. She's calling Putin a thug and is very much against what Trump is saying when it comes to NATO. At the same time, Trump also went after her husband, and President Biden came out and defended her. How odd is that to see? A Republican who wants to get the nominee is actually more in line in this moment with the president from the other party.
It's an interesting dynamic you have. She absolutely went after President Biden, talking about his mental faculties, saying that, he is simply too old. But you're right. She also went after President Trump on issues related to NATO, issues where she actually disagrees with him on critical issues. So I think, maybe it was Lisa that asked the last question. Is this a third party candidate? Are we talking about a mix of personality and policies here? It is very murky as she tries to get through a Republican primary to get the nomination, beating former President Trump in order to get to current President Biden. It's just such a upside down, topsy-turvy dynamic that I'm not sure she's navigating, electorally to a win.
Matthew, as a Republican who's worked on different presidential campaigns, how much is currently what we're seeing an indictment of the primary process, given the fact that someone who could win a general election can't win the primary?
Precisely. You hit it on the head. And I think both parties are struggling with that question. Whoever can crack the notion of the primary process, not putting forth one of the more extreme candidates, but rather putting forth one of the most electable and reasonable candidates, will ultimately rule in the United States for the foreseeable future. But it is a challenging doing that. Make no mistake, 2016, the Democratic Party had a plethora of progressive candidates, Bernie Sanders, Elizabeth Warren, yet ultimately they did not go with their bleeding liberal heart and instead went with Joe Biden, who they felt was the most moderate, electable candidate. To their credit, they won the presidency. Now, obviously, President Biden has challenges, both as a person and maybe even some more progressive policies that make that a little more difficult. Yet the Republican Party seems absolutely happy to proceed with Donald Trump. They are convinced that they will win with him, or they are happy to lose with him. They are not going anywhere. Simply put, Republicans like Trump. This is both parties seem to be digging in, while a majority of Americans seem to be tuning out to possibly both of them.
Do you have a sense of what's driving people to Trump, the Trump supporters? What sort of keeps them there versus broadening out?
It is a mix of policy and personality, make no mistake. You just heard Nikki Haley espouse what is a traditional Republican ethos, which is U.S. leadership around the world, which is free trade, and which is entitlement reform. Donald Trump in 2016 said, no more stupid wars. Said, by the way, it's called fair trade, not free trade. And he said, you're not going to touch Medicare, Medicaid, Social Security. And he won. So that was still a shock to the conservative ethos as we move forward in this town and across the country. And then you have the personality, where the Republican Party, the conservative base voter, it is not about a policy or a set of principles. It is about the attitude, the swagger, the fighting back. And they appreciate that notion. They feel as if they put forth Mitt Romney in the past, a Boy Scout, and was treated poorly. They've put forth other candidates, so why not send Donald Trump? And it seems as if his win in 2016, is enough of a sugar high that will keep them going, even though in subsequent years, 2018, 2020, his ghost in 2022, has only brought doom and gloom for Republicans at the ballot box.
Matthew, you mentioned the Biden win in the primary. Let's just explore that one step further. If it wasn't for Senator Clyburn, there are some people, many people, who believe it may well have been a Bernie Sanders. It wasn't as if there was some grand genius thought in the party to put forward someone that might win on the national stage. Is there a Senator Clyburn in the Republican Party that can turn this around?
No, not at all. Quite the opposite. Anything that smells of establishment, anything that smells of D.C., anything that smells of trying to push voters away from where they are only backfires. There is no cavalry coming. We are a party that is intent on the grassroots, that is very cranky, that is maybe not in a good mood. And you look at even some of the cooler heads here in this town, whether it's a Senator Romney, whether it's, you even look at Mike Gallagher, a young conservative chairman of the China Select Committee doing important critical bipartisan work, who just last week said he refuses to impeach Mayorkas, and now they've pushed him out of the party so much so that he said he's not going to run. It's very challenging times out there.
Matthew, great to catch up, sir, and appreciate the kind words. Matthew Bartlett there of Derby Field Advisors. There is not a Senator Clyburn, and to Matt's point, and I think this is an important point, the reason only a handful, and not even a handful of Republican senators came out over the weekend and pushed back to what the former president had to say about NATO is as soon as you do, on a point like that, you will start to sound like the establishment. And this is the anti-establishment movement that a former president seems to lead.
Which is why when you see defense hawks like Lindsey Graham, Marco Rubio just shrug it off, you realize how far this party has come.
Coming up next, looking ahead to tomorrow's CPI data, 8:30 Eastern Time, about 24 hours and 4 minutes away. Equity futures on the S&P 500. You did not want the Bramo cam then. Equities unchanged on the Nasdaq, going nowhere as well. The Russell, the small caps doing okay, up a third of 1%. The S&P 500's been doing better than okay. 4-day winning streak on the S&P. 5-week winning streak on the S&P 500. In fact, make it 14 weeks out of 15 that this equity market has been rallying. So basically since the end of October, just one direction, equities higher, as bond markets repriced yields lower until recently. Last week, yields higher by more than double digits at the front end of the curve, down by a couple of basis points this morning. But Lisa, we're basically back at 450 on a 2-year. And so far, so good. This equity market has handled it pretty decently.
And when I read the notes about why, a lot of people say, well, the Fed's made the pivot. And it's going to be cutting rates. It's just a matter of when. And oh, yeah, they're not going to necessarily look at hot data and potentially raise rates further. And that's enough to keep this going, even if people prolong some of those, the first rate cut when it might actually happen.
Unless that data does indeed disrupt and derail disinflationary trends. Now, that's going to be the issue here at play. So ISM, prices paid. The wages story, a little bit hot. I think we're ready to just sort of put that to one side until you get more of it, and then the story starts to change. I actually think that the likes of Stuart Kaiser of Citi put it pretty well. So far, so good. Good news, good news. But you get a couple of hot CPI reports in the wrong direction, and you tip the scales the other way.
So who does that hurt the most? And that's what I was really interested to hear from him, because it didn't make him that bearish. Let's say you do get overheating. That's not necessarily a negative for equity investors. So who does it hurt? It hurts bond investors. And really, it raises a question of whether the Fed can cut it all this year, which is the reason why I thought it was really interesting that Bank of America was talking about how, even with no rate cuts this year, you could still see a rally in the equity market.
What did Max Kettner of HSBC call it? Reverse Goldilocks.
Yeah, he called it go-go.
Go-go.
Goldilocks and reverse Goldilocks.
Okay.
He's bet the whole
so
weekend.
Goldilocks on and Goldilocks off.
Yeah, go-go.
A lot of thought went into that over at HSBC, I'm sure. Equities then, just slightly negative, basically unchanged. Bond yields coming in just a little bit. Let's finish on foreign exchange just for Lisa. The euro 107.68, negative there by 0.15%. Under surveillance this morning, your top stories: Israel launching more airstrikes in the southern Gaza city of Rafah. Prime Minister Benjamin Netanyahu vowing to continue Israel's military action despite growing international scrutiny. The White House saying yesterday that President Biden told Netanyahu not to proceed without a, quote, credible and executable plan for the safety and support of civilians. Some growing distance, Annmarie, between those two leaders.
Yeah, a lot of growing distance, especially when you consider Biden's previous remarks in public, where he said he thinks some of what Netanyahu has done has been, quote, over the top. A lot of concern from this administration over protecting civilians, which we've known, given Israel's assault on Gaza, More than 1 million Palestinians are now in Rafah. This is where they sought refuge, and now they want to maybe make a humanitarian corridor going to the north. Or where does Egypt come into play? And you have to think, there is a peace treaty between Egypt and Israel since 1979. And if there's too many Israeli military personnel on that border, that could break apart a peace treaty that's been in place since the late 1970s.
Without a doubt, this is a really delicate situation, but in many ways, this market just seems to be insulated from it all. With crude production in America sky high, record highs. Brent crude's down this morning by 1 percentage point, 81.34. WTI is down a similar amount. WTI crude this morning, 76.12. We can talk about the energy patch, though. Some big deals taking place. Diamondback Energy will buy fellow oil and gas producer Endeavour Energy Resources in a $26 billion cash and stock deal. Diamondback shareholders will own 60.5% of the company when the deal closes, and Endeavour shareholders will hold the rest. The agreement is just the latest in a string of massive deals in the US energy space. At least we've seen Exxon, Chevron, Oxy, all closed deals in recent months.
And massive ones. We're talking $60 billion for Exxon, Chevron's $53 billion one, and now we have a $26 billion one, notably in stock and cash, not in bonds. I just want to point that out. But I do find it interesting. How much further can this go, and what's the purpose? Is this to cut jobs and create efficiencies of scale? Is this because, frankly, you've already drilled the drillable places? This is not about exploration anymore. This is about maximizing production and maximizing efficiency and paying big dividends and doing share buybacks.
Isn't it more than notable how this is financed? Some of this with equity and not raising debt?
I think it's fascinating. I think that this is exactly what we've been hearing from people, that this is sort of the golden goose for a lot of credit investors, is that if you get smaller companies that end up getting taken out, you're going to buy out the debt. There's not going to be more debt issued because it's not attractive financing costs. I find that pretty compelling.
Tons of consolidation in that patch. Let's finish on this. Investors looking ahead to January CPI at tomorrow morning. Bloomberg Economics expecting overall inflation to have fallen to 2.9% last month, marking the first reading below 3% since March 2021. Core CPI is expected to jump year over year, but would still mark the smallest advance since the spring of the same year. If data comes in line with expectations, it would support a disinflationary trend that will determine the timing and size of the Fed's expected rate cuts this year. Torsten Slok, chief economist at Apollo Global Management, joined us now for more. Torsten, we were all bulled up on soft landing Goldilocks talk to start 2024. How close are we to changing that story?
Well, I think it is exactly very ironic that we came into 2023. Everyone said recession, recession, recession. Now we came into 2024. Everyone is saying soft landing, soft landing, soft landing. And as you just suggested, John, if you look at the components of inflation, yes, it may be that in the next month or two, we could still have the disinflationary trend in place. But we're beginning to see more upside pressure on housing. We're beginning to see more upside pressure on wages on a number of different indicators. And we're also beginning to see more broadly an economy that generally is doing quite well because of the easing of financial conditions and therefore because of the labor market still being tight.
What was your base case at the start of the year, and has it changed yet?
So I came into this year, I did expect that this would be a soft landing, but the worry is that the risks have risen that we will not have a soft landing. I think that there's now a higher than 50% chance that we either have a hard landing or no landing. In other words, the fragile soft landing is really almost now the most unlikely scenario, because we now have a situation where if we have a labor market that's still getting stronger because of the easing in financial conditions, no wonder that the employment numbers were so good in January when companies now are IG issuing at the highest level literally in decades in January. You also had high yield issuance was very strong. IPO is beginning to wake up. M&A activity is beginning to wake up. Of course, you should expect to see the labor market do better. And therefore, you should also expect to see wage inflation do better.
Just to point out, we did actually just get another deal announced. So to your point, mergers are really picking up. But here's my question. We were talking earlier about at what point greater inflation would really create a problem for treasuries and yields going higher. When would people start to care about the deficit again? And you've been pointing out that the supply is just dramatic, that there are $10 trillion of U.S. treasuries coming to the market this year, and that there really are not the same number of buyers to suck them up. So when does that become a problem, considering that the auctions have been pretty good so far?
Yeah, the interesting thing about that discussion is exactly that we're shifting from, it used to be that we had yield insensitive buyers, which was China, sovereign wealth funds, people who really didn't care too much about what the level of U.S. treasuries were trading at. But now we have shifted to, in the last 2 years, yield sensitive buyers, including U.S. households. We have pension risk transfer. We have a lot also on the insurance side. We also have, broadly speaking, domestically, a lot of sensitive to interest rate investors. That basically means that that change in the narrative could become very important, in particular if we now begin to think that the Fed is cutting rates. Well, what does that then mean if suddenly those buyers of rates have been much more yield sensitive than what we've had for a long, long time. So the change in the buyer base of treasuries is absolutely beginning to play a role.
So why hasn't it, right? People say because the retail investor is coming in and they're trying to lock this in. Is there a threshold at which the retail investor gets spooked, stops buying, and then it's sort of a self-fulfilling prophecy where higher yields begets more selling, not buying?
Well, you see very clearly in the data, when the Fed began to raise rates, you saw households begin to buy more treasuries. So you would expect to see, well, if the Fed begins to cut rates, households are potentially beginning to lose appetite. Think about all the money that is in money market mutual funds, about $6 trillion at the moment. If we begin to see the Fed cutting rates later this year, a lot of that money probably will begin to find its way elsewhere. So the discussion is there still appetite to buy duration now that the buyers of duration for the last 2 years have been yield-sensitive buyers relative to what the buyer base looked like even just 5 years ago?
The idea that the Fed may not cut rates as quickly or as much as people are expecting raises another kind of question around commercial real estate and some of these other rate-sensitive areas. Do you end up with a more systemic problem if rates remain higher for longer in a way that most people are not gaming out?
Yeah, I mean, let's be totally clear. Higher cost of capital is biting harder and harder every single day in a number of different areas. And one area, of course, is that if we do have rates higher for longer, because the inflation problem we just talked about is not going away, that will continue to create more and more risk of financial stability issues down the road, including for commercial real estate. Because we have a lot of different asset classes that essentially were priced on zero interest rates that are now, quote unquote, waking up and beginning to be repriced at a much higher cost of capital. So it really is page 1 in your finance textbook. When the cost of capital goes up, the longer that persists, the more it bites harder and harder, not only on corporates, but also on consumers. So that's why the lagged effects of monetary policy will continue to weigh on the outlook. But it is very distributionally different as a function of who has most leverage, who's most vulnerable, who has the lowest coverage ratios, who's most vulnerable to interest rates staying high.
I'm biased, but I've got a lot of company. Big fan of your research, always have been. Torsten sends out homework on the weekend for his readers. A weekend reading.
Did you do it this weekend?
Yeah, I know. I did a little bit of this weekend. It's like having a professor over at Apollo. He gives me my reading list for the weekend. Auto delinquencies is something you pushed out this weekend. How does that stack up with this theory that the economy is doing really well, it's resilient, it might push out this disinflationary story at the same time we're seeing delinquencies climb?
It touches on this very important point that there is a distributional spectrum both for consumers and for firms, namely those that are most impacted by higher cost of capital are entities with higher leverage, with weaker cash flows, with weaker earnings, weaker savings, and in the corporate finance world, weaker coverage ratios. And the consequence of that is that those companies, it's not surprising, what's happening is that those companies and those households that have fewer savings, that have lower FICO scores, that have higher debt levels, they are also the ones that are getting impacted. So that means that there therefore is a spectrum of who is being impacted by Fed hikes. There's some who is not really being impacted, value investors most importantly, and all those over there to the right, venture capital, tech, growth, some parts of healthcare, some parts of consumer retail, they are the ones with most leverage. They are the ones that are seeing the biggest impact.
That, I think, almost directly speaks to some of the dissatisfaction in terms of some segments of society that they have with this economy in this country. Inflation pressures are still very real for some of those families as well. The inflation scars that I think we've accumulated since 2020, you don't just leave behind because inflation year over year drops to 2-3%. The president's out there talking about shrinkflation. Now, I'm not going to push you on the politics of that. I want to talk about the economics of that. When you hear things like, this is down to price gouging, this is down to corporate greed, what's your reaction to that?
Well, I would say, generally speaking, I mean, it's not surprising those who have most debt are those who are most vulnerable to interest rates going up. But the sources of inflation were either supply, which was supply chains getting screwed up during the pandemic, it was problems with not getting things delivered during the pandemic, or it was demand. And we had a lot of fiscal stimulus that was way more than any other country in the world. All that meant that we did get a lot of inflation. And it is really not surprising that you have distributional consequences, both of higher interest rates, but also of higher inflation. And what the New York Fed data that you just alluded to showed, of course, also now is that it is younger households, the households in their 20s and 30s, they are falling behind on paying their credit card bills and their auto bills at the fastest pace, essentially since 2008. So that's also telling you that the impact is that younger households, of course, have more debt, because when you're young, you buy a house, you have more debt, buy a car, you have more debt than older households. So that means that those that have more debt are the ones that are seeing the negative impact of rates going up.
And I think they're sick and tired, Bramo, of being told how good this economy is.
Which is the reason why I guess we heard about shrinkflation, which you just very skillfully avoided and basically said everything other than that, which is maybe the causes that other people look at.
This White House is struggling to connect with those people pretty clearly.
I mean, look, it's such a complicated story, and it raises this question of just whether people are getting it right at a time where it seems like it's moving in the right direction, but people are still feeling those higher bills.
I'm not sure if you connect with them by going on TikTok. What did you make of that? Launching a TikTok account, the campaign?
For the campaign, well, this is how they want to reach the youth. More and more, when you look at the stats, the youth are pulling their news not from mainstream media, not even from places like Twitter. They're actually getting news clips from TikTok. There was a back door the White House used to do. Still probably is doing it. They would give an interview, say to someone who is very prolific on TikTok, then have that person put out the interview because they couldn't have the president have his own TikTok. But now the campaign is saying we need to reach these people and we're going to do it.
Just to be clear, the president signed a law which banned TikTok being on federal devices.
Government devices. Campaign is different.
Isn't that amazing? It's banned from being on federal devices, but campaign devices are okay.
You really want to hear my opinion on this? Do you actually want to hear my opinion?
Please.
This is the difference between policy and politics, because ultimately you have people saying that they're concerned about the data and what a Chinese-owned company and where that data goes, and then you have them using that same platform to try to reach voters, because guess what? That's what they're on. So to me, I mean, this just really highlights where we're going to be at for a long time.
You can't wait. Operation Get Re-elected. There's often that big space between good politics and good policy. Torsten, you're avoiding that one, and for good reason. It's good to see you. Thank you, sir. Torsten Slok there of Apollo Global Management. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. U.S. Defense Secretary Lloyd Austin has been hospitalized for the second time in a month. The Pentagon chief was admitted to Walter Reed late Sunday with an apparent bladder issue. His deputy, Kathleen Hicks, has taken over functions and duties. It comes weeks after Austin was criticized for failing to disclose that he'd been hospitalized on New Year's Day for complications from prostate cancer surgery. Citi is facing new demands to change the way it measures the risk of its trading partners. According to Reuters, U.S. regulators sent the bank 3 notices last year, telling it to address the matter in the coming months. Citi told Reuters that meeting regulators' expectations was a top priority, while, quote, making steady progress, simplifying and modernizing our bank. President Joe Biden will host Jordan's King Abdullah at the White House today, The two are expected to discuss the latest military operations in the port city of Rafah and efforts to secure the release of Israeli hostages held in Gaza. The visit also comes after last month's deadly attacks on U.S. forces in Jordan from Iran-backed militias. That's your Bloomberg Brief. John.
Danny, thank you for that. Appreciate it. Up next on the program, a record-breaking Super Bowl.
It's been an incredible season for the NFL on CBS. We set the high watermark for ratings since the property returned in 1998. On Sunday, we'll set an all-time viewing number with any luck.
That's coming up next, live from New York. This is Bloomberg. Live from New York City, counting you down to the opening bell, about 42 minutes away from the cash open. Equity futures here on the S&P totally unchanged, have been for much of this morning actually, treading waters going into CPI tomorrow morning. Yields are lower by a single basis point on the 10-year, 416.18, and crude pulling lower to start the week, down about 1 full percentage point, $76 on WTI. Under surveillance this morning, a record-breaking Super Bowl.
It's been an incredible season for the NFL on CBS. We set the high watermark for ratings since the property returned in 1998. We set the high watermark for ad sales for a Super Bowl. And it's looking like on Sunday, we'll set an all-time viewing number with any luck.
It's the latest today. The Kansas City Chiefs beating the San Francisco 49ers in Super Bowl 58, becoming the first back-to-back champions in 19 years. Viewing figures are not out yet, but it's forecasted to be the most watched Super Bowl in history. Brands still spending $7 million per commercial as more fans cut cable and head to streaming. Joining us now is Brian Weiser, principal at Madison and Walls. Brian, can we just get into that briefly? The usefulness of spending that much money on a 30-second ad in a Super Bowl. How big is it still?
Well, it's still massive. I mean, Fox last year, I think, generated about $600 million in revenue, and presumably Paramount will see more than that. From a marketer perspective, keep in mind, advertising is a least bad alternatives business. It's not about whether something is good or bad. It's about whether it's better than the next best alternative. And for the sake of reaching a massive audience, getting this water cooler effect, building a campaign, building brands, there really isn't anything comparable to the Super Bowl.
Brian, TV is losing appointments to view. Quite clearly, because when you look at some of the most watched things in the last 12 months or so, it's dominated by sports. Sports seems to be the last place we have these appointments to view where advertisers want to be because they know that's where eyeballs convene, get together at exactly the same time. Brian, how unique is that in American football now versus, say, everything else?
Yeah, and it really is American football over everything else for the United States in particular. Listen, it dominates the sport or dominates the industry right now. And that's why this whole announcement last week from Disney and Fox and Warner is so potentially important, because it's already a situation where from an advertiser perspective, you really value the fact that you get casual viewers. That's the only way you make this so important as an advertising vehicle. You get people who don't necessarily want to pay a la carte for that sports programming that's so important, the NFL in particular. And the more that it shifts into a streaming world, the harder it will be to actually reach audiences, the less valuable it will become for advertisers.
Brian, before we go on to the Super Bowl and talk about some of the advertisements, what was advertised and how you view that, particularly with entertainment, there was this analyst report from Wells Fargo talking about that service you were talking about from Disney, Paramount, and Warner, that if the service could hire or could attract 6 million subscribers, it could charge at least $40 a month. They're discussing a price that's $50 a month. This, according to people familiar with the matter. Is that kind of the price range that you're looking at?
Well, it's not clear exactly, but yeah, I can only go on the reports that are out there, which suggest something along those lines. And to the extent that that happens, I'm just kind of mystified how they're going to thread the needle and find an audience that somehow cares enough about sports to pay that much, but isn't already subscribing to pay TV. In other words, they'll attract people who are already traditional pay TV subscribers, and that's going to diminish the value of the overall ecosystem. Now, with that said, as I pointed out, remember when Hulu was created, it was considered ClownCo, and that was in part because they didn't have a name, but also because of the concerns around dysfunction of a joint venture. There is the risk that this becomes ClownCo 2.0. And if that happens, well, then maybe it doesn't actually matter.
Brian, I'm curious about what you thought about the advertisements. What was sort of your big takeaway? Mine was personally just about movies that were being advertised, that they all paid that much money and said, go look at the trailer. What was your takeaway?
Well, actually, I didn't even watch the game. I was too busy doing other things, watching Apple TV programming, actually. But no, I did see the CeraVe ad, and I thought it was quite amusing. And I certainly have read a lot of analysis about them. There's so many of them. I think that this fine line of balancing celebrity and brand, and the CeraVe one was a really good example for a L'Oreal product where actually, yeah, like you get attention because of Michael Cera, but it actually kind of made the point of what the brand's trying to do. And they're going to make that brand more of a household name than it was before.
BetMGM spent $50 million on their ad. What is the bang for the buck on something like that?
You have to think of this in context of a campaign, because if all you're doing is spending $7 million on an ad and you think that's enough, it's not. I mean, you get a lot of attention for something, but keep in mind, millions and millions of dollars typically go into the whole process of creating a campaign. And this should be the start of a bigger campaign. It shouldn't be the end of it, right? And so, yeah, $50 million for a brand. Think of it this way. A typical packaged goods company might spend 10% of their total revenue on advertising. In some categories, services in particular, like say betting, sports betting, it could be 30, 40, 50% of revenue has to be devoted to advertising and marketing. And so if you expect to generate hundreds of millions of dollars for something that's kind of inflated as a business by its brand,
true,
spending $50 million isn't anything.
Brian, have you got a number on luxury? How much of revenue from a luxury player is spent on marketing?
It's actually very high for some. Like LVMH, it's something like 20 to 30% of the total revenue on total marketing. But what's really interesting is you look at an LVMH, they don't actually spend that much on paid advertising through traditional media. They do a lot of social, there's a lot of event-related marketing, but they don't spend a lot of TV. But it's a very high percentage of their revenue.
We're talking about a very unique opportunity to market whatever service or product you're trying to sell, the Super Bowl. How is ad spend stacking up elsewhere?
Well, it's growing quite healthfully everywhere, at least at an industry level, but television, it's not. Keep in mind, television should actually decline this year. Television probably declined by a mid-single digit level in the fourth quarter, and I expect something similar through 2024. Meanwhile, total advertising should actually grow by about mid-single digits, excluding political advertising. Digital advertising and Meta, Alphabet, Amazon, TikTok, as you were talking about before, are the primary beneficiaries.
Brian, great to get your thoughts. As always, buddy. Brian Weiser there of Madison & Wall after the Super Bowl ads over the weekend costing $7 million. I think that's $7 million for a 30-second spot, right?
Yeah.
$7 million.
But I guess if you're capturing how many eyeballs, I mean, some people are saying it's going to rival 1981, where 49% of American households watch the Super Bowl or something insane like that they think it could be that kind of proportion, then it might be worth it.
What was last year? Close to 115?
Yeah.
I think it's fair to say it's going to be more than that.
Yeah, I wonder how many people were actually watching the game, though. I mean, honestly, how many people actually watch the game?
So you've got the game.
Yeah.
You don't see much because there's always a commercial break. You've got the commercial breaks.
Right.
You've got halftime.
Yeah.
Then you've got Taylor Swift. And I know everyone's sick to death of hearing the Taylor Swift effect when it comes to American football, but you'd have to imagine it's pretty real.
Honestly, I was just wondering about some of the commercials, whether they would be there if it weren't for the female base.
Right.
There were a couple of them.
The mix is shifting.
Yeah, the mix is shifting.
It's a big deal.
She was only shown for 55 seconds.
So how much is that? Do you want to do the maths on it? Like 15 mil?
Exactly. It's probably quite
14 mil? 13 mil? Something like that.
Yeah.
We'll work that out for you tomorrow
No, we
morning.
won't. We
Coming up
absolutely won't.
tomorrow, Jim Zalter, Apollo Asset Management co-president, David Herro, CIO at Harris Associates, Jay Bryson, chief economist at Wells Fargo, and David Kelly, chief global strategist at JP Morgan Asset Management, all joining us tomorrow morning for CPI Tuesday. That data 8:30 Eastern Time. Going into the opening bell this morning, equities just a little bit softer after a record-breaking streak continues on Friday. Closing north of 5K. More still to come potentially from New York. This is Bloomberg.